good morning, people. Hope you're all doing good. Just in case you're asking, I'm doing amazing as well. So, some of you have been asking RTP November 2024 wala review or the analysis. So, in today's session, we'll be covering November 2024 ka RTPs. Yes? Okay, so let's try to cover all this in as less duration as possible because I know that some of you are watching this at the last moment. Pretty straightforward RTP, to be honest. If I'll have to overall rate, not that tricky question. Maybe one or two questions has probably newly come. Even they are not that difficult. Okay, but otherwise more or less pretty straightforward RTP in my opinion, if you ask. All right, so without delay, let's get started, people. So first we have a MCQ based case study question. So as I told, sir, the way you should start solving case study based question is always before you read the question or read the case study, look at the requirement first. So the moment when you read the requirement, why do we say this is? Sometimes they'll give you a lot of data in the case study, but the requirement could be very straightforward or theory oriented, where you don't need so much of information. The moment you look at the question, you can select the option right away. So there will be like that. And usually case study questions, they will give multiple standards, they'll combine and make a case study. So when you read the requirement, you'll get a basic idea as to which particular Ind AS or standard is being tested in this particular scenario. So if you just check over here, they're talking something about revenue, some finance income, some trade receivables. So that means this particular case study is dealing with revenue recognition, meaning this whole case study is on Ind AS 115. So let's see what they're trying to ask through this particular case. First, on October 1st, 20x6, D Limited sold a product to a customer for 1,21,000. So your transaction price is 121. The amount payable is 31st December 20x8. Oh, check, sir. Sir, 1st October 20x6 was the contract date or sale date. The payment date is 31st December 20x8. That is almost what, sir? Not almost 2 years. After 2 years and 3 months, you're making the payment or you'll receive the payment. Sale will happen today, but the amount you'll receive after 2 years, 3 months. So that means obviously this particular transaction has what, sir? Significant finance component, SFC is there. So whenever SFC is there, we have to record what, sir? The revenue at cash selling price or cash price equivalent or cash selling price, we say. All right. The difference between the transaction price and cash selling price will be your interest income component, which will be transferred off to SPL account. So this is your transaction price. Great. Then the manufacturing cost is 80,000. That's okay. That we need to reduce from COGS. Inventory will get reduced to the extent of 80. The customer had a right to return the product for a full refund at any time up to 31st December 20x6. So you sold the product on 1st October 20x6. 3 months, October, November, December, till 31st December 20x6. That is for 3 months. The customer has a right to return the product. So that means this is sale with a right to return concept. And we already studied this. Whenever a goods are being sold with a right to return, right? Can you recognize the revenue right away? No. First, you have to find out how many quantities you have sold under the right to return option. Let's assume that we have sold 100 quantities. In this 100 quantity, we have to estimate how much quantity the customer may return. The company feels 90 will not be returned. 10 may be returned. This entity has to estimate. First, they have to find out the total quantities sold under sale with right to return option. In that, how much quantity are not expected to get returned? That you have to find out or that you have to estimate. And how much quantity is expected to get returned? That you need to estimate. And on the quantity not expected to get returned, on that you can go ahead and recognize the revenue. On those quantities which are expected to be returned, you cannot recognize the revenue right now. If you have received the amount, you have to recognize refund liability. Also, you have to recognize the right to recover the asset at cost price. All this we have discussed in our regular case study, and we have done some ICA case-based MCQ. Also, separate video is available on YouTube. That also, in that case studies also we have discussed the same concept. Yes. So here this is getting triggered. This I've assumed. This is not this particular relevant information. This is just an assumption I've made. Okay. So let's proceed further. On October 20x6, D Limited had no reliable evidence regarding the likelihood of return of the product by the customer. So on the sale date, that was on 1st October, we are not able to estimate. First of all, Ind AS 115 says that you have to estimate how much will not be returned, how much to be returned. If you're not able to estimate, sorry boss, then you will not be able to recognize the revenue. That means what? On 1st October 20x6, sorry, you cannot recognize the revenue. Alright, till which date? So you have given sale with the right to return for 2 years? No, it's only till 31st December 20x6, that is for 3 months. Meaning on 31st December 20x6, the sale with the right to return option get expired. On that day, 31st December 20x6, you can go ahead and recognize the revenue, right? If you are able to estimate, then you can recognize the revenue on 1st October itself. Here we are not able to estimate, hence the revenue recognition will only happen on 31st December 20x6. That's one. The product was not returned by the customer before 31st December. Great. And so the right to return has expired. On both 1st October and 31st December 20x6, cash selling price is given as 1 lakh. Here SFC is there, no? So revenue should be recognized at cash selling price, which they have given. On both these dates, CSP, cash selling price, they're saying is 1 lakh only. Alright, now look at the first requirement. What are they asked? In fact, maybe I'll read off this. Yeah, this is a separate case study, so we'll read off this. When and by what amount revenue to be recognized? So revenue will book only on 1st October. No, revenue will recognize only when, since you're not able to estimate, you will recognize the revenue only when that sale with the right to return option gets expired, which in this case is 31st December 20x6. Okay, and how much will you recognize the revenue for? At cash selling price. What is the cash selling price? 1 lakh. So D for Delhi is the right option in this particular case. So means what journal entry we should pass it? Journal entry they have not asked, just in case if you want. On 1st October, you've already given the product to the customer, so your inventory has to be reduced, right? So that means reduce your inventory by crediting inventory, right? But if the customer returns the product, we have an obligation to return the money. So we have to book refund liability, which they have not told whether we have received the money or not. So refund liability will not talk. But at the same time, when the customer returns the product, we have an obligation to pay him the money. But at the same time, we have a right to recover one goods called inventory, right? Hence, we will also book a corresponding asset called right to recover the asset. This right to recover the asset will be booked at, this represents your inventory, hence you book it at cost price. Here they have given the cost of the product to be 80,000. So this journal entry you will pass to the extent of cost price, which is 80,000. That is on 1st October, the day you gave this goods. Now on 31st December, what happens? Now, right to recover, this is there, no, the right has got expired. This is a right towards inventory, no? Inventory will you show it in P&L under which category? Cost of goods sold. So this right to recover the goods or right to recover asset will be adjusted with COGS, cost of the goods sold. Hence the entry will be COGS account debit to right to recover the asset account to the extent of same value. This way, this particular component gets nullified. Okay, na sir? Effectively, the inventory got adjusted with cost of goods sold, because in your SPL, inventory you will not show as a separate category. It comes under the cost of goods sold. Hence this particular entry. Done, sir? Now on 31st December, what again? That right to receive, sale with a right to return option has got expired. So can we recognize the revenue? Yes. So the entry will be financial asset data as account debit to revenue. Revenue will be recognized to the extent of cash selling price of 1 lakh rupees. Done, sir? Yes, sir. Now the problem here is you have recognized debtor at 1 lakh, but will you receive 1 lakh? No. The transaction price is 1,21,000. So transaction price is 121. Okay, your cash selling price is 1 lakh. So the difference between these two is your interest income. 21,000 is the interest income which you will book it to, which you will book as a finance income to or interest income to SPL account. So you have to put up that ACM table, sir. Yes, you need to put up this ACM table for how many years? 2 years, 3 months. Okay. So now the sale you booked on 31st December. Current year, in fact, if you just check the question, they said somewhere over there that year is ending on 31st March. Okay, 31st March 20x7. Right. So put up the ACM table only for current year. So that will be what? Opening balance, interest income, then receipts, then your closing balance. What is the opening balance of debtors, sir? You booked the debtors to the extent of here 1 lakh rupees. That becomes your opening balance. And you have to book finance income based on the interest rate. Have they given the interest rate check somewhere? Yeah, the discount rate is given to be 10%. So book 1 lakh into 10%. But don't book it for whole year. So you book the revenue on 31st December and year is ending on 31st March, 3 months later. So for the first year, interest income will be booked only for 3 months. 1 lakh into 10% into 3 by 12, that gets you 2,500. In the first year, you have not received any money because you will receive the money only after 2 years and 3 months. Hence the receipt column 0. Closing balance will be these two addition minus this 2 plus 3 minus 4. We have done all this so many questions in our regular class. I hope I don't have to spend too much time on this. Yes. So adding this, debtor ka balance become 1,02,500. All this they have not asked, just giving you a recap so that in case they ask anything in this entry, you can choose to. You can easily tackle them. Now looking at the first answer MCQ, we have already started. Then they have asked what is the finance income. Finance income we already got now 2,500. So 2,500 is there in which option? Option number B for Bengaluru. That's the finance income. Then they are asking what are the amounts of trade receivable on 31st March, not 31st December. 31st December it was 1 lakh. 31st March, look at the ACM table. The closing balance of debtor has become 1,02,500. So select that option which has 1,02,500, which is C for Chennai. That's your first case study. First case study is the 3 MCQ which is related. Now let's go ahead and study or go through the next the case which is given in the same next para which is given in the same case on 1st July 20x5, D Limited began an arrangement to sell the goods to a third party. Fine. The price of the goods was set at 100 rupees per unit. So we made a contract that we will sell the goods at a price of 100 per unit. And this agreement we have made for 2 years. For all the 2 years, we will sell it at a constant or an agreed price of 100 per unit. Okay, great. From here, 1st July 20x5 to, if you count 2 years, that will become 30th June 20x7. However, if the sales of the product exceed 60,000 units in the 2-year period ended 30th June 2007, then the selling price of all units retrospectively will be set at 80 per unit. So we have told the customer, if you buy more than 60,000 units during the 2 years, for 2 years put together, if the number of units which we sell to the customer exceeds 60,000, then the price will be retrospectively, not for the extra unit. Okay, suppose you sell 65,000 units, the benchmark is 60, extra is how much? 5,000. This extra alone you will not sell it at 90. What they are trying to say is what, sir? If the number of units exceeds 60,000, then the price of all the goods will be retrospectively adjusted at 90. So entire goods of 65,000, which I've assumed, right, will be sold, or whose selling price will be taken at 90 per unit. We have done such question in our regular class. This is not a new thing to us. Okay. Now let's see what happens. Sale of goods to B Limited in the 9 months period. You made the agreement on July, no sir? Okay, so from July, August, September, October, November, December, January, February, March, if you count, that's about 9 months. For the 9 months in the current year, okay, the sale units was only 20,000. For 9 months in the current year, when the year you made the contract, from July to 31st March, if you count, that's about 9 months. Totally you have sold 20,000 units. Okay, fine. And this volume of sales per month was not expected to change before 30th June. We are saying this particular same trend will continue. Sir, you made a contract for 2 years. 2 years as in 24 months, right? In that, how many months has passed? 9 months is already over. That means the remaining months is 24 minus 9, which is 15. They are saying in what proportion and in what ratio you made the sales in the first 9 months, in the same trend, the same will be followed for the other 9 months also. So you need to prorate. What is that? For 9 months, if the sale is 20,000 units, for 15 months, how much will be the sale? So if you calculate, it will be, if you prorate or X method, you will get cross multiplication, you will get 33,333 units. So in the next 15 months, company feels they may sell 33,000 units. 20 already sold, 333 is expected to be sold more. So if you add up the two, you're going to get how much, sir? 53,333. What was the benchmark or parameter? Benchmark for retrospective revision was 60,000 units. It should exceed. Is it exceeding? No. Company feels it will only be around 53,333. So it is not exceeding 60. So what will be taken as the price? 100 per unit. So in the current year, you have already sold 20,000 units. Now, for that 20,000 units, your transaction price, you will take it as 100 rupees per unit, because we are not expecting that the threshold of 60,000 will be crossed. Okay. All right. That is one. So check, have they based any question? Yeah. They're saying how much revenue will be recognized in 20x5x6 in the current year. How many units have you sold? 20,000. What is the price? 90. No. Since it is expected to fall or be less than 60,000 units, the price will be taken as 100 per unit. So the revenue that you will book in the current year is 20,000 into 100, which is 20 lakh. A for alpha is the right answer. Okay, sir. This is first year ka drama. Next, they've asked for the next year. Next year, have they given some data? Yes. Come back. However, in the year ended 31st March 20x7, the year 2, the total sales of the goods were 35. Okay, great. 20 already sold. 35, yes, come. So that means it is 55 already. And based on the current orders from B Limited, the estimate was revised. The directors of D Limited, the company, estimated that the total sales of the goods to B Limited in the 2-year period ending 30th June would be more than 60,000 units. In the first year, they thought that it will not exceed 60. Hence, the price was taken at 100 per unit. In the second year, now they are saying, based on the order size they have received in the year 2 so far, they feel it will definitely cross 60,000. If it is expected to exceed 60,000, can we take the price as 100? No. You have to retrospectively revise to how much? 90 per unit. In this case, what do you have to do? Multiple ways you can do it. Like maybe I'll show you one. So what is the total number of units you have sold, sir? 20 in the first year, 35 in the second year. So totally you have sold 55,000 units, right? Now on this 55,000, what will be the revenue per unit? The revenue per unit, since it is expected to cross 60, revenue per unit, you should take it as 90 per unit. So 55,000 into 90 you do, it will be how much? 49,50,000. Meaning on entire 55,000 units, totally you can recognize the revenue of 49.5 lakh. Yes? Right? Have you already recognized some revenue? Yes. In the last year, you have already recognized a revenue of 20 lakh. So totally you can recognize 49.5. In this 20 lakh, you have already recognized it in the last year. So how much revenue you will recognize in the current year? 49.5 minus 20 lakh, which will be 29.5 lakh. That way you can do it. This is one approach. Or you can also revise, meaning in the current year, how many units did you sell? 35,000. What is the price per unit now? It is expected to cross 60. So that means the price will be taken as 90 per unit. So on this, you'll book a revenue of 31.5 lakh. Okay. What about the previous? Sir, the last year you sold 20,000 units. No. Revenue should actually be booked at only at 90 because there is a retrospective adjustment. But you took how much in the last year? 100. So how much extra revenue you have taken? 10 rupees extra per unit. Now, for 1 unit, 10 rupees extra. For 20,000, how much? 2 lakh. That you reduce it. You will get the same answer. So whichever way you feel comfortable, you can do it. Multiple ways. Mathematics, you can present it in multiple ways. So they've asked the revenue for the second year. Revenue for the second year will be 29 lakh 50,000, sir. That's all with respect to first case study of 5 questions. Pretty straightforward, nothing new as such. All such questions we have done in our regular class. Okay. I hope I can maintain the space because we are not going through the entire things. All right. We are quickly reviewing it so that our timelines of the session is on the lower side. So, okay, sir, let's get to the case study too. So this case study is on India's 19 employee benefits and India's 16 ka, some combination they've given. Let's see. Messrs XYZ is an auditing firm. During the audit, the firm is facing some difficulty in accounting and they are asking for your help. A Limited has an established defined benefit pension plan. So DBO they have, okay, for its eligible employees. The balance sheet of A Limited as on 31st March 2007 currently includes estimated net liability. Keyword there is estimated net liability. So they did not use the word liability. Liability means your DBO. Defined benefit obligation. They use the word net liability. So how does this work? Sir, we know this. As far as India's 19 goes, there are one liability called DBO, defined benefit obligation, or you can call it as provision for DBO, whatever you want to call. Yes, for simplicity, we'll take it as DBO. There is a liability called defined benefit obligation. Similarly, there is a corresponding asset called plan assets, right? So do we show both these things in balance sheet? No, we net off, right? Plan assets and DBO we net off and show that too as what? If liability only is higher means we'll show it as net DBO. Right? Or if asset is higher means we call it as net defined asset. Here they're saying net liability. So provision for DBO or DBO is greater than plan assets. By how much? 18.75 crore. So they have not given DBO and plan assets ka balance separately. They have netted off and given the balance. And moreover, this is the balance as on which date? On 31st March 2006. Our current year is ending on 31st March 2007. They have given net DBO on 31st March 2006. So it is opening balance. Okay. So the opening balance of net defined obligation, meaning after knocking off DBO and plan assets, the liability portion is only higher. And how much is it higher by? 18.75. So that is your opening balance. Great. Next, following matters relates to the plan for the year ended 31st March 2007. They have given next current service cost. So what happens? Due to current service cost, your DBO balance will increase. You already have a liability, no? So due to current service cost, DBO balance will increase. So what do you have to do for this adjustment? 6 crore, add up. So current service cost will increase your DBO by 6 crore rupees. And this current service cost also is being an expense, it will be transferred off to P&L account. Great. On 31st March 2007, A Limited paid a contribution of 7 crore into the plan. Contribution means buying additional plan assets. So when you make a contribution, plan asset balance will increase, right? Here they have not given plan asset balance. We have got net DBO balance, meaning after adjusting plan assets with the DBO, what is the balance they have given? Okay. So if plan asset increases means what will happen to your net DBO? We have a liability here. Sorry, due to this particular component contribution, plan asset will increase. That will have a corresponding impact of what? Net DBO ka decrease. Yes, no? Like here, if you have, let's say, plan assets of 100, let's say DBO of 100 if plan asset is 70, right? Let's assume that. So net DBO will be how much? Net DBO will be 100 minus 70, which will be 30. This is what is given to us in the question. Now we have made some contribution, meaning you have purchased additional plan assets. How much? 7. Then that means what will happen? From this 70, this will become 77. This will have no impact. Due to contribution, DBO has no impact. So this will be 100 only. That means now you calculate how much this will be. This will be what, sir? 23. Yes, no? Correct. That's the balance. 100 minus 77 is 23. Check what happened. Sir, due to this contribution, plan asset increased by how much? From 70 it became 77. So it increased by 7. But what happened to your net DBO? Net DBO from 30 it became 23. So net DBO, okay, DBO net effect will reduce. That's what I've written here. And in this problem, they've given net DBO. So what should we do for this contribution? This contribution we need to reduce, right? Less contribution, 7 crore. Because due to this, plan asset will increase and net DBO will reduce. That is the reason. Okay. Alright, the annual market yield on high quality corporate bond is 8%. Now we have to calculate on plan assets and this interest income, interest expense, no sir. But they have not given plan assets separately, DBO separately. They have given off netted off number. So which is the net number higher? It's a net DBO is the higher number. So that means on the liability, we have to calculate interest charges. We have done this, right? And interest charges we need to calculate at the rate of 8% on the opening balance. 18.75 is the opening balance. Of that 8% if you calculate, it will be 1.5 crore. This is your finance charges or interest charges, because what they've given is your liability. On liability, there will be interest charges. On plan assets, there will be interest income. Here, plan liability is greater than plan assets. So you'll have to book a net interest charges over here. This is a net amount, okay? Which is 1.5 crore. And again, this net interest charges also will be transferred off to SP interest charges, so it will be expensed off to P&L. Great. But 1 minute, hang on, or maybe I think this is a mistake over here. I'll discuss this. Maybe next one I'll go off. Net liability on 31st March 20x7, advised by the actuary is 20.5. This is the balance at the end of the year. So closing balance, they've given it to be 20.5. All right. So now through those only, what do we need to calculate? Actuarial gain or loss. Yes, no. So if you calculate all this and compare with this, okay, 18.75. plus 6 minus 7 plus 1.5 if you do. Adding all this, you should have got 19.25. But your actual liability is not 19.25, it is 20.5. So liability balance has increased. So this is what, sir? Liability increasing means it is an actuarial loss. So actuarial loss, which is arrived as balancing figure, which is 1.25 crores. Like this. Okay, na, Saru? Alright, this is what all this we have done. But the thing is, in our regular class, they used to give DBO and plan assets ka balance separately. So we used to work them separately. Here they've given off a netted off number. So accordingly, take that netted number and work it out. That's all it is. Just a different way of asking the same question. We have done so many questions like this in our Ind AS 19. Yes. Okay. Now one more word which probably missed out is contribution, sir. 7 crore you made, meaning plan asset you purchased, and charge this amount as operating expense. Our super duper accountant, we purchased a plan asset, which is an investment, right? When you purchase investment, it's an expense. Will you transfer it to P&L? No. But our accountant has expensed it off. So that means it is a mistake, accounting error. So what we have to do? He has treated this as an expense. So P&L balance has been debited due to expense debit P&L. No? So now we have to reverse this expense. So due to this, P&L balance will be credited, or we have to increase the P&L balance in this particular case. What have they asked in the question? So let's read that. This case study, we'll look at it later. What is the amount of net adjustment to be made in SPL they're asking? What is the net adjustment they're asking? So 3 things. 1, is there any interest charges? Yes. Is there any current service cost? Yes. Have you done any mistake in P&L? Yes. So those 3 you need to adjust. Accordingly, tell whether you have to increase P&L or decrease P&L. First, due to our this working, current service cost and interest charges, both are expense. Due to expense, you have to debit P&L. 6 and 1.5. So totally 7.5 crores you need to debit to SPL. Current service cost and interest charges. Then plan assets contribution which was made. It was not an expense, but our accountant booked it as an expense. So he has already debited P&L, which we need to reverse. So how much expense was unnecessarily accounted? 7 crore. So you will credit SPL to the extent of 7 crore. This is the error which has been rectified now. So for 7 crore, you will credit SPL, 7.5 crore, you will debit. So what is it? They ask net adjustment. 7 credit, 7.5 debit. So what is the net adjustment? 0.5 crores only is a net debit that will be given off to SPL account. So which has 0.5. So see, for Chennai has that particular point. We are debiting P&L means obviously P&L balance will be reduced. So 0.5 crores will be reduced or deducted from current year profit. Okay, so that's the right answer. Then they've asked actuarial gain or loss. That we already calculated. No, actuarial gain loss we got it as balancing figure as 1.25 crores. So select that as the right option here. Okay, sir. That's all with respect to this particular case. Actually, there's one more. Okay, I think there's one more case study and some question backing that. So let's run through that. On 1st April to x0. Okay, maybe first x you can keep it as 0, other x you can keep it as 1. Your understanding, it's okay. Yeah. E Limited completed the construction of a non-current asset with an estimated useful life of 20 years. Great. They completed the construction. The cost of construction were recognized in PP. Great. Depreciation is also charged. E Limited has a legal obligation to restore the site on which non-current asset is located on 31st March to X20. So that means this is 2020, meaning 10 years later, you have an obligation to restore. So obviously this is your decommissioning and site restoration cost, DSR, for which we need to make provision for DSR. Correct? Now, and this provision for DSR, will you charge it to SPL? No. It will be capitalized. Yes. DSR cost can also be added to the cost of PP, but DSR cost will be added to the extent of present value. Correct? Yeah, the estimated cost of restoration cost after 10 years, that is on 31st March 2020, will be 2.5 crore. This 2.5 crore is a future value. Can we add 2.5 crores to PP? No. Find out the present value and then add, right? The directors of E Limited have made a provision for 0.125 crores. Okay, how did they find out 0.125 crore? So 2.5 crore is the total amount expected, no? And when will you when will you expect this payment? After 10 years. So they took 2.5 crore divided by 10. That will be how much? 0.125. For that they made a provision. Okay, sir. All right. So this what they have done. So which is correct or wrong? So absolutely wrong, sir. Yeah, this is not accepted. Okay. And when they say they've made a provision, they pass the journal entry SPL account debit to provision. They pass the journal entry SPL account debit to provision. This is what they have done. Okay. Now tell me, sir, for provision for DSR, when they say provision made, this is the entry they have made. For how much value? 0.125 crore. Is this acceptable? No, sir. Provision for DSR 1, you should not make it at that amount. Okay. It's not total amount of provision divided by total number of years. No, you have to find out the present value. So this amount is also wrong. And the entry is also wrong because we don't debit SPL. We have to debit what? PP. It should be capitalized. So that means amount and the accounting treatment what they've done is wrong. Okay. So what is the requirement they've done? Yeah, this is as on 31st March 20x1. Great. An appropriate discount rate is given to be 6%. And for 20, okay, this they're saying, okay, actually this is not 10 years, actually it is 20 years. Okay, my bad. Yeah, whatever it is, it's okay, great. Okay. So they're saying after 20 years, PVIF, present value interest factor at 6% is 0.312. So that's a data given. Let's see what is the requirement to be done. What is the original amount of provision to be required? Or if you ignore what is they've asked, okay. So if you want to just run through this data, 1, PP cost have they given? No. So you'll write cost of PV construction. I've written XXX because it's not given in the question. That's all. No. Since provision for DSR cost can be capitalized, we will add it to the cost of PP. But addition should be made at the present value. What is the provision for DSR? Future value is 2.5 crore. PVIF is 0.312. So 2.5 crores into 0.312 if you do, you'll get 0.78 crores. That is the present value, which you will capitalize. Yes, no? So then you'll get the carrying amount. And this particular carrying amount will get depreciated, right? So now they've asked the net impact somewhere over here. Okay, what will the amount of adjustment to be made in retained earnings, right? Okay, since they have not transferred the provision for DSR, means they have not capitalized provision for DSR but transferred to SPL. What they've done is wrong, no? Correct? Because they made a provision means obviously the amount shown in P&L is overstated. They have debited P&L, but actually debit should have given to PP. Right? So two impacts there is what they have done we need to reverse, and once you add this provision for DSR to PP, carrying amount of PP will increase. So due to this, depreciation also will increase, right? So we need to calculate the depreciation impact. Since they have not given the total carrying amount, no problem. At least do we know provision for DSR ka present value? Yes, right? So this will increase the carrying amount. So due to this, carrying amount will increase by 0.78. So depreciation also will increase. So due to this 0.78 ka provision for DSR, how much extra depreciation you're going to get? 0.78 crores is amount. Residual value not given 0. Life is given to be 20 years. So if you do this, it will be 0.039. That much is depreciation on the asset? No, this is the extra depreciation arising on asset due to provision for DSR. And this also will be transferred off to P&L. Since they've asked the impact on retained earnings, we have to calculate this. Okay, na sir? I hope you got it. So if they had given the cost of PP, I would have taken that and calculated full depreciation. Since cost of PP ka data is missing, I can only calculate due to this provision for DSR how much extra depreciation you're going to get, which is 0.319. Done? That's all? No. You'll have to do unwinding of interest here. That means ACM table? Very much yes. So put provision for DSR ka ACM table. For whole 20 years, sir? No, they only ask for current year. Okay. And all this provision has come on 1st April only. So year beginning. So you'll calculate the interest charges for whole year. Provision for DSR ka opening balance is 0.78 crore. Right? Then book finance charges. What is the discount factor they gave? 6%. So on liability, you book finance charges, right? So book it at 6% for the whole year. Then there is no payment because payment for provision for DSR you will make after 20 years. So closing balance will be these two ka addition and payment ka minus. That's what I've written as 2 plus 3 minus 4. So provision ka closing balance will be 0.8268. So this is what will happen. I've just showed it to you as a working. Right now, so let's see what is the requirement of the question. They're saying what is the amount of original provision required to be made. Actual provision, how much you should make. That is what, sir? cost multiplied by the total amount of DSR cost, which is 2.5 crores, multiplied by your PVA, basically present value, which we already calculated here. What is the present value of provision for DSR? 0.78 crores. So that is the provision you should actually make. That's what I've written over here. Now, that is what you need to make, right? Next, they've asked, what is the adjustment to be made in retained earnings? Few adjustments. One, have they made provision? Yes. How did they make provision? They wrote SPL account debit to provision, right? So unnecessarily SPL has been debited. So what you have to do, whatever they have done, you need to reverse. So SPL should be credited by 0.125 crores. The provision which they made using SPL should be reversed, because this is not a normal provision. You have to capitalize this, but they have used SPL and made the provision, hence reverse it. So this is a reversal impact. Then what, sir? Now, on provision for DSR, you get interest charges for current year. How much is that? 0.0468, right? Interest charges is an expense. Due to expense, SPL will be debited. So 0.0468 finance charges will be debited to SPL. That's all? No. Due to this provision for DSR, you will get extra depreciation. Due to this, again, SPL will be debited. So two debits in SPL you will see. One is for depreciation, additional depreciation due to provision for depreciation or due to provision for DSR. Another one is finance charges, 0.039 and 0.0468. That's what I've called out. So these two, due to this, P&L will be, SPL will be debited. Due to this, it will be credited. So looks like credit only is more. So netting of these two, you will get what, sir? 0.0392 crore. So it looks like credit only is more. So hence the net credit you'll have to give it to SPL is 0.0392. That they've asked the net adjustment. And which adjustment has 0.0392? Option number C. So that is the right answer over here. Again, a rectification error wala scenario this is. Okay. Not a new concept, just a different way of asking. I feel it would have been better if they had given the carrying amount of the asset, so that we could have given a little holistic picture there, because many of the students will forget this, because in their mind what will be there, sir, anyway cost is not given, so how can we calculate depreciation? Like that they'll ignore off, right? So this you need to be a little careful of. Okay, so since they've done something wrong in provision for DSR, so there will be an impact of provision for DSR on depreciation. So do not forget this excess depreciation part. That is one mistake which can generally happen in these sort of questions. Okay, then what will be the amount of 1 year's unwinding of interest on reservation? 1 year unwinding of interest is first year ka finance charges. We already got it now here. First year ka finance charges is 0.0468. Okay, that is what they've asked. First year ka got it. So with this all the case study based MCQ question, we have damar over. That's all, nothing else. Chintu question, nothing. Yes, no. So overall pretty straightforward. Yes. Now let's run through the descriptive questions. Okay, can we get started with the descriptive one? Yes. X Limited is an Indian company. They hold a freehold land. Fine. The carrying amount is 10 lakh. Okay. Which is not depreciated. Land, no. Obviously, it has unlimited useful life. So, no depreciation. Great. It is not depreciation for tax purpose also, but it is indexed for inflation. So, whenever you sell land, you'll get indexation benefits on LTCG, right? So that they've asked. The indexed value and fair value of the land is 15 lakh and 22 lakh respectively. So the indexed value is 15 lakh and the fair value is 22 lakh they've given. Okay, that means what? Up to 15 lakh if you're selling price, if you're selling the asset, means you don't have to pay any tax to the government. Though you purchase for 10 lakh, the indexed value is 15. So if you exactly sell it at 15, the selling price will be 15, indexed cost also will be 15, so profit on sale will be 0. Right? If you sell it at a price higher than 15 lakh, you may have to pay some LTCG. Okay, what will be the tax base they're asking? So this is what's an Ind AS 12 income tax wala question. Right? Tax base they're asking under different scenario for the measurement of deferred tax. Okay, so they're not asking you DTA or DTL, they're specifically asking you what is tax base under all the scenarios. X Limited, the company, they intends to sell it as in land, freehold land, as part of slum sale of a business. If you just read the next line, they've told that in the applicable tax laws in the jurisdiction, indexation benefit is not available if the freehold property is sold as part of slum sale. Slum sale is in, you have not sold the asset alone, you have sold the whole business, right? If you're selling the whole business, we call that such a scenario as a slum sale. So if you not sell the land alone, but if you sell off whole business, then they are saying indexation benefit will not be available. Okay, great. So now in the first scenario, the company will sell it not individually, but on a slum sale basis. So on a slump sale basis, if you're selling means, will you get that indexed benefit of 15? No. That means what? Carrying amount and tax base here will be same. So carrying amount is 10 lakh, tax base also will be a first case. Both carrying amount and tax base will be same. So is there any difference? No. So that means no DTA DTL will arise in the first particular scenario. Okay. Second case may they want to sell the land individually. So if you sell it individually, will you get will you get the indexation benefit? Yes. So how much indexed value will become? 15 lakh. So in the second case, my carrying amount is still 10 lakh, but tax base will not be 10. Since you get the indexed benefit, the tax base will become 15 lakh rupees because you're selling it individually. So is there any difference? Yes. What is the difference? 5 lakh. What do we call this as? We know this. For asset, if carrying amount is greater than tax base, for asset, if carrying amount is greater than tax base, we call it as taxable timing difference. On this we create deferred tax liability. So here if carrying amount is lesser than tax base, it becomes deductible timing difference. On that we have to create deferred tax asset. Here carrying amount is lesser than tax base, so we get deductible timing difference of 5 lakh. So on this we'll have to create deferred tax asset based on prudence and tax planning opportunities, etc., which they have not commented. The question requirement is only tax base, which is 15 lakh. Extra fitting we are just discussing. We can't calculate DTA DTL here because the tax rate is not given to us in the question. Alright, the way I see tax rate, I did not see. It's not given. Alright. So if tax rate is not given, you don't calculate DTA DTL. In fact, they have not asked also. They have only asked a tax base in the question. So do what is required. No need to do extra fittings. Yeah. X Limited has classified land as investment property. It doesn't matter, sir. Even if you classified as investment property, for investment property, revaluation model is not allowed, only cost model is allowed. So already the carrying amount is how much? 10 lakh. So carrying amount will be still how much? 10 lakh only. Okay. And they want to sell this what? It's classified as investment property and intends to sell individually and not on slump basis. Since you're not making a slump sale, will you get, but rather selling it on individual basis, will you get indexed benefit? Yes. So tax base will become how much? 15 lakh rupees. I mean, it's the same as the above answer. So there will be a deductible timing difference. You need to create DTA in this particular third case also. Fourth case, they're saying company follows revaluation model. So revaluation model means showing the asset at fair value or market value. How much is the market value? 22 lakh. So the carrying amount is 10 lakh, but the fair value is 22 lakh. So happy face, 10 has become 22. So this is a case of revaluation gain. How much is the revaluation gain? 12 lakh rupees, right? So this revaluation gain is an OCI item or revaluation reserve. You will transfer 12 lakh to revaluation reserve, which is an OCI, other comprehensive OCI item. Yes, 12 lakh rupees. Once you book, since you're following revaluation model, carrying amount from 10 lakh, you have to bring it to 22 lakh. So carrying amount will become, or the revised carrying amount will reach the fair value mark or market value mark, which will be 22 lakhs. But all this revaluation and all is there only in India 16 wala drama. Taxation, maybe we don't have all that drama. So tax base is still how much? Sir, will you get indexed benefit? Yes, because you're still planning to sell it individually. So hence tax base will be how much? 15 lakh. The revised carrying amount due to revaluation has become 22 lakh. Tax base, since you're selling it individually, you will get indexed benefit, which is hence it is 15 lakh. So carrying amount is greater than tax base. So you will get what? Taxable timing difference of how much? 7 lakh rupees. So on taxable timing difference, we need to create DTL. So deferred tax liability. But one thing keep in mind, if they ask the same question with tax rate and ask you DTA, DTL, be careful here. You know that DTL ka creation entry is what, sir? Either you will write SPL account debit to DTL, right? Either you will use SPL or you will use OCI. Correct or no? So OCI account debit to DTL, whichever is OCI. Normally the revaluation reserve, the OCI is a common item we use. Correct? No? Now this particular DTL, there's not DTL amount. You have to take the difference and multiply tax rate, right? So this particular DTL, what you create, right? It will not be created using SPL. Since this particular DTA or DTL in this case is arising due to revaluation, this DTL also should be created through OCI itself. And which OCI? Revaluation reserve. So entry you have to pass for DTL amount here is revaluation reserve account debit to deferred tax liability, whatever being the amount based on the tax rate. Keep that in mind. They have not asked, just for your reference. Right? Okay, 4 cases done. That's all they asked. Tax base, they asked 1 on marker, maybe each case study. Right? Fair enough. So that's all is this question. Pretty straightforward one. Over. Next is India's 116 cases. Again, a theoretical case study. A repetitive one. We have done such question in our regular class as well. Without further delay, let's quickly run through that as well. First scenario. The last mile is a dedicated cable that connects entities Y's network with end customer's device. Some network cable, we have probably leased it out. The use of this cable is at the discretion of the customer. The way the customer wants to use this cable. So the customer has the right to control or RTC over this identified asset. Some cable we have leased it out probably. Entity Y decides the customer is what is that? Customer is lessee, entity Y is us, the lessor. Okay, so entity Y decides the location of endpoints and has a right to replace the lines. However, it is not practical to replace the lines since replacement would incur additional cost to be incurred without any corresponding benefit. Would the arrangement be within the scope of leases? So we have studied a small concept called entity. If the entity has, or if the supplier has SSR, substantive substitution rights, or SSR we call it, supplier substantive substitution rights. If supplier has SSR, then the customer does not have RTC over identified assets, meaning it will not be a lease. Because if customer is going on, if the supplier goes on replacing, substituting the asset, then you can't identify asset only. For you to call it as a lease, which asset you have taken it on lease, you should be able to clearly identify. If supplier goes on replacing it, then you will not be able to identify the asset. So if you are not able to identify the assets, the whole Ind AS 116 ka drama will not get attracted, right? And when can you say supplier has SSR? There are two conditions for it. If you want to prove that, normally we assume, in the absence of information, I have told you in regular class that we assume that supplier does not have SSR. If supplier has SSR, you have to prove it by satisfying both the condition. One is the supplier should have a practical ability to substitute the asset throughout the lease term. That is one. He should have the ability to substitute it. Okay. Second one, it should be beneficial. It should be economically feasible or beneficial for the supplier to replace it. By replacing, you should be getting some benefits. If both the conditions are satisfied, means we say supplier has SSR. In this particular case, yes, supplier can replace it, but is it beneficial for him? No. See, however, it is not practical to replace since the replacement would require additional cost without corresponding benefit. By replacing, the supplier will only incur extra cost. Benefit is not there. That means what, sir? Second condition is getting failed over here. So supplier has SSR here? No. Since supplier does not have SSR, will it be a lease? Yes. The customer has a right to control the use of identified asset because asset will not be replaced usually. Yes. So in this first case, yes, it will be a lease. So lease ka provision will be applied to this particular case. Scenario 2, if it is practical for entity to replace the lines and entity Y would benefit from this replacement, they have modified the above case. They are saying we have the ability to replace also, and they are saying we will get some benefit due to replacement also. Supplier has a practical ability to replace throughout and he'll get some benefit. Then in this case, supplier has SSR. If supplier has SSR, is it a lease? No, it does not become lease because you cannot identify the assets. The customer, if supplier has SSR, means the customer will not have RTC over the identified asset. Hence, in the second case, it will not be a lease. Not a new question at all. Many questions we have covered in regular class. Okay, next case, Customer X, different contract. This is customer X enters into a 10-year contract with a utility company. Okay, the entity Y for the right to use 3 specified physically distinct fibers, 3 cables, maybe I'll read out the whole sentence. Customer X enters into a 10-year contract with a utility company, entity Y, for the right to use 3 specified physically distinct fibers within a larger cable connecting Mumbai and Delhi. So there is a fiber cable, internet cable from Bombay to Delhi. So one company has many such cables running. In that many cables, one customer has told 3 cables I want. So which 3 clearly has been identified. So you are able to tell. So it's a distinct asset. Okay, 3 cables, only customer X will use and nobody else will use this. Okay. The customer makes the decision about use of the fibers by connecting each end of the fibers to electronic equipment. So customer clearly defines how to use it, when to use it, etc., etc. So does customer have right to control the use of an identified asset? Yes. He has a right to direct its use and he is getting all the substantial benefits. So customer has right to control the use of identified asset here. Entity Y owns extra fibers but can substitute those for customers' fibers only for reasons for repairs, maintenance, malfunction. So we have many cables running between Bombay and Delhi route, right? So in that 3 has been leased out to a customer. So the supplier of this 3, anyone or all the 3 can be replaced. Under every circumstance, no. If there is any problem with the 3 cables, if it is not functioning properly, if it has got damaged or whatever, then the supplier will replace it. Now, will we call this as SSR? No. Substituting after a specific event or after a specific point of time is not considered as supplier does not have SSR. Yes, we have studied this provision, right? So only if some condition comes in like malfunction, damage, then only we will replace. So does supplier have SSR here? No, supplier does not have SSR. So does customer has a right to control the use of identified asset? Yes. So will it be a lease? Yes. In this particular case, it is definitely a lease here. Now the next case is just a modification of the above case. Same 10-year contract with the customer for the right to use a specified amount of capacity. Sir, in the previous cases, the customer took lease to use 3 specific cables. Suppose 100 cables was there. In this 100, 3 specifically was leased out. Okay, that was this above case. Now what they're trying to say, it is not a specific cable leased out. Check. The entity X enters into a 10-year contract for the right to use a specified amount of capacity within a cable, right? So obviously, let's say one cable has a capacity to transmit about 1000 GB data, right? One customer is saying, I need only 100 GB of data, meaning 10% of capacity only we have leased out. So one cable, all right, we have leased out to many users. We have studied this concept. If one asset is leased out to many users, means for that user or for that customer who's using the asset for its substantial capacity and getting substantial benefit, for that customer it will be a lease. For all other customers it will be a pure supply arrangement, purchase arrangement. It will not be a lease, which we had studied this. And here substantial capacity means 95% or more. We had studied one question in study material. There they had taken 95% or more as substantial capacity, hence we are keeping that as a benchmark. Yes sir? Okay. Now here they have given specified amount of capacity. Whether if it was substantial, then generally they will call it out in the question. They will mention it in the question. Since the word substantial capacity is not mentioned in the contract, the customer is not taking this asset and using it for its substantial capacity. So how to decode? There is an absence of information here because whether it is substantial or not given. But the way you will answer in the examination is, if it is substantial, the word substantial will be mentioned to you in the question. If the word substantial is not mentioned, or at least they'll give you percentage. If both the word percentage as well or substantial, if it is not used, then you will assume that it is not substantial. Meaning, customer is not using it for 95% or more, but lesser. But for you to call it as a lease, it has to be a substantial capacity usage. Okay. Since the word substantial is not used in this particular question, so you will take it as what? The customer is not using the asset for its substantial capacity. So will it be a lease? No. In this case, it will not be a lease. Hope you got the difference between the above two case study, right? In the above case, just to be on the safer side, I'll repeat it. The first case, we have many cables. In that, 3 cables was specifically given to one customer and full usage. Nobody else uses 3 cables but one customer. In the second case, let's say we have one cable. This one cable is being leased out to multiple vendors. Let's say X, Y, Z. Like this. All the 3 entities will use this one particular cable. Alright. So this is what we mean by a single asset leased out to many vendors or many customers. Okay. So if many customers are using single asset, only those customer which is using it for substantial capacity, and substantial capacity here refers to 95% or more. Only for that customer it will be a lease. For other customer it will not be. Since the word substantial is not mentioned in this case study, we are assuming that it is not a substantial usage. Hence it is not a lease. Okay, sir. That's all is this particular case study, all the drama all about. So you have to write some theory, all that I've given in the chart book. No? So write some pointers like this and then call out. Here we are doing a quick discussion. I don't want to waste my time or yours time for that matter, writing the whole provisions and all that. That you know how to answer. No? We are doing a quick discussion because I'm sure all this you're going through on the examination day or few days before the examination. So all those points you can take care of it, right? A quick snapshot, a quick review to save time is what what this session ka intention is all about. Okay, sir. That's the reason if you just check all the pointers I've written in come so that you can refer it, because if I have to write it, another 25-30 minutes of time will get wasted. So for me, 30 minutes may not be too much because I've already cleared my examination. But for you, 1 week before the examination or 1 day before the examination, 25-30 minutes can be very costly. So just to save all that time, I've written this extra fittings and come so that we can quickly review and finish this particular session. So, okay, next question is on Ind AS 41 agriculture. So let's review this. Question number 13. ABC is one entity. They are in business of manufacturing an apple beverage, Appy Fizz, some apple drink they are making, whatever drink, we don't know, maybe Appy Fizz only. Yeah? So manufacturing of an apple beverage and requires a large quantity of apples to manufacture such beverage. Okay, obviously if you're manufacturing an apple drink means you need a lot of apples. Yeah. In order to satisfy its requirement of apples, it enters into a 3-year lease contract with the owners of apple orchards. So some farmers are there who own some apple orchards, some acres of apple trees they own. That only we're calling it as apple orchards. Okay, a land on which the apples are grown. It's called apple orchards. So some farmers own this apple orchards. To them or with such persons, with such farmers, they made a contract saying what? You supply the apples. They've given the terms. The lease contracts are mainly of 2 types. Contract number 1, with few people, with few owners. The owner of the apple orchid, that is a lessor, raises the apple trees to produce apple. That particular farmer, he is responsible for putting the apple seed, making the apple tree grow, etc. etc. All that responsibility or towards apple tree is not ABC Limited ka, but farmer ka. Yes, no, that is the lesser is what they're trying to say. ABC Limited, you know what they do? Makes a fixed annual payment to the owner of apple orchids who is required to cultivate the produce. Owner will cultivate the produce as per the specification of ABC. ABC harvests the apple itself for fulfilling the requirements. Sir, farmer will put in all the schoon pasina, full sweat to blood and all. He will grow that apple tree and all. He'll keep up it. Later, like a James Bond, ABC will give the money. Lease means obviously we have to make lease payment. No? So we'll make some payment to the farmer and say, your job is done. Next, I will go to ABC is telling, I will go to that apple orchid or apple farm, pluck the apples. We will go and take or pluck these apples. That is our business. That's what we mean by harvesting. Harvesting simply is plucking. Pop all efforts that farmer is doing. Okay, we simply make the payment and we pluck it out. The question here is, can we say the first contract, is it an agricultural activity as per Ind AS 41? Okay, as per Ind AS 41, for you to apply this standard, it should be an agricultural activity. Is it an agricultural activity for contract 1? No, sir. Why, sir? Sir, if you want to call it as agricultural activity, we have studied this in regular class also, we have written it also. 1, you need to manage biological transformation. If you are managing the biological transformation, meaning if you're putting the seed, protecting the tree, spraying pesticides, so etc. etc. If you're managing that whole transformation from apple seed to apples, if you're managing, then that we say as managing biological transformation. If you're doing it, then we say you're doing agricultural activity. Here, what are we doing? Say everything farmer is doing. At the end stage, we go and just pluck the apples. Correct? No, that's all we are doing. So we are not managing this biological transformation. So it is not what's agricultural activity in this particular case. First contract is not an agricultural activity. That's all theory question. Second contract, ABC obtains the apple orchid from the owner. Oh, second case we don't go like James Bond and pluck the mangoes. We told our farmer, you give that piece of land to us. Okay, they obtains apple orchid from the owner to raise apple trees for subsequent harvest. So in the second particular case, we will only go and manage it. Okay, we have purchased that apple orchid. Okay, we will put in more seeds, we will protect the tree, hire some laborers, make sure that apple tree is protected, spray pesticides or whatever activity needs to be done to get the apples, from end to end, we will only manage in the second contract. So this is the second type of contract. These are one type of contract, this is another type of contract. We have entered in multiple farmers. This is a contract. So second contract, are we just going and plucking? No, we only are doing everything. So in second case, will it be agricultural activity? Very much yes. Since we are only managing all this, so we are managing biological transformation. So it will be what's agricultural activity. Okay. Alright, and then we harvest, and because of this we make some payment. So in the second case, yes, it will be an agricultural activity. That's all is the question all about. Is these two contracts an agricultural activity or not for us to apply Ind AS 41? First one may no, second one may yes, it is. That's it, sir. Very, very chin to question. Can we go for the next one? Yeah, next one I would say is a little different. Yeah, so a little important you could say. Okay, sir. So let's get started with the next question. This question is on Ind AS 10, events occurring after reporting period. H Limited constructed a warehouse at a cost of 10 lakh in 20X1. So we constructed. Great. It first became available for use by H Limited on 1st April 20X2. Maybe on 1st April on X1 we started the construction. It is available for use only on 1st April 20X2. Few months or few years later, it is available for use. Great. On 29th April 20X6, sir, it is available on 1st April 20X2. Now we are on April 20X6. So if you roughly count, so it's about 4 years, 1 month. So after 4 years, right, some extra fitting is happening. From here to here, if you count, that's about 4 years, or 29 days or 1 month. So what happened on 29th April after 4 years? H discovered that its warehouse was damaged. They constructed this warehouse, They're saying that it has got damaged. Okay, why? We'll see. During an early May 20X6, an investigation revealed that the damage was due to structural fault in the construction of warehouse. So this warehouse has got damaged. We got to know about damage 4 years later, in the 5th year, right? Yeah. And what is the reason for this damage? At the time we constructed, So overall structure we need to build, right? There was a fault in that structural itself, meaning the construction itself, we have done a faulty construction. Okay, we have not constructed properly. The base is not strong, or we used incorrect materials or whatever. Okay, so at the time of construction itself, we had done some mistake. That means what, sir? Think, sir, damage wala condition, right? Though you have detected later on, it was already existing. Damage was already there, just that we got to know little later. I mean, what am I hinting towards? Sir, this is an adjusting event. This is an adjusting event. Sir, yes sir, because this is not damage due to earthquake or fire, flood and all. Earthquake or fire, flood means the condition is not existing on balance sheet date. So it becomes non-adjusting. Here, this damage is due to a structural fault, right? There was some wrong in the structure, and structure you have constructed already before. You knew, just right? That means the fault was existing on the balance sheet date or before itself. Just that you have detected it later on. So this is like an error. Right? Error was already there, but you detected later on. We had written all errors, frauds are adjusting event, but it should be detected before approval of financial statements, right? So that wala scenario this is. Okay, so this is an adjusting event, okay, because it's a structural fault and not due to fire, flood. If the question was due to fire, flood, earthquake and all, then it will be a non-adjusting event. The fault became apparent when the warehouse building leaked severely after heavy rainfall, 27th April. We got to know that there is a damage when the water started seeping inside the factory. Leakage happened. The discovery of fault is an indication of impairment. So due to this, they are saying, obviously, sir, if warehouse is getting damaged means obviously that will be a loss to the company. No? So this they are saying is impairment indicator. So whenever there is impairment indicator has arise, we need to find out recoverable amount. They've estimated recoverable amount and got it to be 6 lakh. Great. Furthermore, H assessed the useful life of warehouses 20 years from the day it was ready to use. Okay. Alright. Before discovering the fault, H had depreciated the warehouse on a straight line method at nil residual value over 30-year life. So before this default was identified, detected, life of the warehouse, total life of this warehouse was 30 years. Now after this defect was detected, now they are saying it is not 30, the total life is 20, not 20 years remaining. People check. The reassess the useful life of 20 years from the day it was ready to use. From the day it is available for use, they are saying 20 years. So 20 years is the total life they are saying. Initially, the total life estimated was 30. Now they are saying due to damage, the total life estimated is only 20. This 20 is not remaining life, because here you need to calculate depreciation and all. That's the reason I'm stressing upon this word. Yes, 20 is not the total life. It's not the total remaining life. It is the total life itself. From 30, the total life has got revised to 20. So any revision in the useful life, is that a change in accounting policy? No, this is a change in accounting estimate, which we have to do it prospectively as per Ind AS 8. Yes. Okay, that will also come, sir. Yeah, obviously, when the life changes, depre also will change, sir. Yeah, and moreover, this is an adjusting event. So that means, though all this drama is happening next year, since it is an adjusting event, we have to record it in the current year itself. That is the drama. Okay, so that means all the data we need to recalculate, because it's due to structural damage. Structural damage was already existing, so it is an adjusting event. That is what I've written over here. Since structural fault condition was existing on the balance sheet date or before, this becomes an adjusting event. Hence what, sir? Current year ka depreciation and carrying amount of PP and all you need to adjust, because they have calculated depreciation by keeping the total life as 30. Now the life has got become revised to 20. So if life changes means obviously the depreciation will change. If depre changes means carrying amount of PP also will change. Hence we need to rework. So how to calculate this part? I will read it later on. Okay. Current year is ending on 31st March. Okay. And moreover, check for it to be adjusting event, right? It should be first event. What is an event? For you to call it as event, it should be occurring between a particular window. What is that window? Balance sheet date and the date on which financial statements are approved. Here, balance sheet date is 31st March 20x6 and the date of approval of financial statement is 28th May 20x6. This is the cutoff. And this particular event, this fault and all, you got to know about 29th April or 27th March, April, somewhere around that. 29th April they discovered, so we can write this. So 29th April 20x6 you have discovered that there is a fault. So is this an event? Yes. Since it's happening before the approval of financial statement, it is an event. And what sort of an event? Adjusting event. Hence things needs to be revised. So now how to work out? Sir, what was the cost of the asset when you purchased it? 10 lakh. So how many years has passed? So from 1st April 20x2 it is available for use. Current year is ending on 31st March 20x6. Okay. 31st March 20x6, if you count it as, how much it will be? 31st March 20x3, x4, x5, x6, 4 years, correct? No. So 4 years they have already calculated depreciation. But current year depreciation, I will calculate and show it separately because of adjustment. Meaning 4 years, entity has already calculated depreciation. First, let's do it for 3 years. What will be depreciation? Carrying amount is 10 lakh, residual value is 0. Initially, they are depreciating using the life as 30 years. I've only calculated for 3. So 4 no. Current year ka I'll show it separately. I'll tell you why. Okay. 3 years ka depreciate separately. 1 year ka current year ka I'll show it separately. In a bit, I'll tell you why. So for the first 3 years depreciation, total depreciation is 1 lakh. So every year is 33.3333. Yes, no. 10 lakh divided by 30 years if you do, you'll get 33,333. For 3 years, if you round it off, it will be 1 lakh rupees. So carrying amount of the asset at the beginning of year 3 is 10 lakh minus 1 lakh, which is 9 lakh. Okay. But now we are on 31st March 20x6, right? 31st March 20x6. We have got carrying amount as on 31st March 20x5 because only we have reduced depreciation for 3 years. So what will be depreciation charged in the current year? Charge in the current year is same. Whatever depreciation you have done for 3 years, same manner you have done it for 4th year also. So what will be depreciation? Same SLM method. So depreciation will be 33.33. Same calculation. 10 lakh divided by 30 you do. Oh, don't multiply it by 3 because I need only current year ka. So if you do this, you will get 33.33. Or you can rework it also. I've told straight line method ka formula is not original cost. It is actually carrying amount minus residual value divided by remaining useful life. Okay. But since straight line method will give you same depreciation every year, we don't do the calculation. Hence, instead of carrying amount, we say original cost. But actually, it is carrying amount. So if you want, you can recalculate. Carrying amount here is 9 lakh. Residual value is 0 divided by remaining life. So 30 years you bought. 3 years is already passed. So remaining life is 27 years. So if you calculate, you will get 33,333. Same. Correct. No, this they have already charged. So what is the carrying amount as per the accountant? 8,66,667. This is what they have done. But hang on. Now, is this an adjusting event? Yes. Structural damage was already there. So is it an adjusting event? Yes. So should we, though this event has occurred in the next year, should we account it in the next year? No. Since it is adjusting event, we have to do all the adjustments in the current year. Yes. Due to this adjustment, will there be any impact on depreciation? Very much yes, because due to this damage being an adjusting event, life has got re-estimated. Life now, the total life is not 30, it is only 27. It is only 20 now. So since life has changed, depreciation also will change. So what is the depreciation actually required for current year? For comparison purpose, I calculated current year ka depreciation separately over here. Hence, I did not complete it. Even if you want, you can calculate for 4 years depreciation together also. It will not do no harm. You will get the same value. Okay, this is just for comparison purpose. Okay, so what is the depreciation actually required for 4th year? What is the carrying amount? 9 lakh divided by residual value still 0 divided by what? Life. Now after damage, the life is not 30, it is only 20. Right now we are in the 4th year now. That means 3 years is already passed. So total life is 20 after the damage, and 3 years is already passed. So the remaining life is 17 years. So take this. Okay. Due to damage, the total life is revised to be 20. From 30, it has become 20. And 3 years is already passed. So it should be 20 minus 3, which is 17 years. So if you calculate, you will get 52,941. So for current year, accountant has charged 33, but required amount is 52. For this comparison purpose, I calculated depreciation for current year separately. Charged is 33, required is 52. So additional depreciation we have to charge in the current year due to this adjusting event. So additional depreciation charge is what? These two ka difference, which will be 19,608 rupees ka depreciation accountant, or we need to charge in the current year more. Okay. So entry will be depreciation account debit to PP, that is warehouse, this particular entry. That's what we need to do. Done. Yeah, and they're saying that this damage is an impairment indicator, so we need to calculate the impairment loss ka impact. Okay, so what is the carrying amount now, sir? Carrying amount was this. We have, if you charge additional depreciation, carrying amount will reduce. So the carrying amount will become 866,667 minus additional debris of 19,608. If you calculate, it will become 847. Carrying amount, do you know? Yes, they have only given in the question. The recoverable amount, not carrying amount rather. Recoverable amount is given to be 6 lakh rupees. Sir, carrying amount is 847. Recoverable amount is 6 lakh. So is carrying amount greater than recoverable amount? Yes, carrying amount is greater than recoverable amount means, well, impairment loss arise in the current year. All these are adjusting events. So will it come in the current year ended 31st March 2006? Very much yes. So how much is the impairment loss? 247,059. Pass the entry for impairment loss. Impairment loss account debit to PP warehouse, this particular entry. This is what you need to call out, that component. That is the requirement of the question. Prepare accounting entries, 2 entries. One is additional depreciation, other one is impairment loss ka entry, which we have done. Okay, sir. Ignore tax impact, they are saying. So DTA detail, need not be worried about. Disclosure requirement, they are asking. There's one more, which we will talk about it. Now this is about warehouse, that is PP. Now they're saying seepage of rainwater. One more paragraph of this particular question we had not studied. We'll read this and then take up the second requirement. Seepage of rainwater through the crack in the warehouse caused some damage to the inventory worth 1 lakh. Since the warehouse has got damaged, okay, and due to the structural fault, okay, so due to that damage, the water has started coming inside the warehouse. Okay, and there's a rainfall and water has come inside the warehouse. Maybe ours is a sensitive product. Okay, since the water has come in, our inventory has got damaged. Inventory worth how much? 1 lakh rupees. Okay, so due to that particular warehouse damage. Okay, and became unsellable. Now we are saying nobody will buy this inventory. Okay, maybe we had to protect it, and due to water gate and all, it has got mixed to the inventory, and the inventory is damaru. Okay, the entire damaged inventory was on hand at 31st March 20x6. It's not sellable now. So all that stock, the damaged goods inventory, we are holding at year end. So we have not taken any insurance also because we did not anticipate this. So our stock was not insured. So what are we to do for this? Sir, is this an adjusting event? No. Why, sir? Sir, warehouse, there was a damage that was due to structural fault. And structural fault was there at the time of construction only. So hence it is an adjusting event. Now this damage is due to water coming in due to rainfall. Correct? No. Right? Was this existing on the balance sheet date? No. This was not existing on the balance sheet date. So this inventory damage condition is not existing on the balance sheet date. Yes, no, sir? Yes, correct. So hence this will be treated as what, sir? Non-adjusting event. That way, this is a very good question is what I said. Again, warehouse damage was due to the structural fault. Structural fault was existing since many years. So condition was already existing on balance sheet date. So hence it is an adjusting event. But this water coming in through rainfall because warehouse has got damaged, probably there is some space through which the water has come in. Right? So that condition and all was not there on the balance sheet date. Yes, no? Now due to heavy rainfall, the warehouse has got damaged. There is some leakage and due to this water has come in and inventory has got damaged. So this is not these conditions are not existing on balance sheet date. So it is a non-adjusting event and we studied this. In non-adjusting event, what do you do, sir? We only give a disclosure in the current year financial statement. So this particular para requires a disclosure. That's the disclosure requirement that they are talking about. Okay. Next scenario, they're asking, what will your answer be different if there was no structural fault and damage due to warehouse had been caused by an event that occurred after 31st March 2006? Now they are saying warehouses got damaged. Not on 31st March, after 31st March. But this is not due to structural fault and all. Okay, maybe due to heavy rainfall. There was a heavy rainfall, because of that building has got damaged. Or due to fire or flood, earthquake and all, it has got damaged. Now what, sir? Now is the condition existing? No, if it is not due to structural damage means, then it will be what, sir? Both will be non-adjusting event. Meaning the damage which is caused to the factory as well as the damage which is caused to the inventory. Both will be treated as non-adjusting event and you only give a disclosure. Right? That means all that additional depreciation, impairment and all will not come in the current year. Because it's not an adjusting event. No? So in the current year, no additional depreciation will come because life will get revised, but not in the current year, but in the next year, non-adjusting event. So hence additional depreciation entry and all will come in the next year. And impairment indicator also, since it is non-adjusting event, right? So impairment indicator also in the current year, it is not available. It is there only in the next year. So impairment loss also will not come in the next year. So only disclosure would be required in that particular case. That way, a good question. Just the presentation part you need to be a little worried about. So these same calculations you can write the way I have presented here. If you write, that is good enough. Yeah, maybe for 6 to 8 marks they can give all this. So these many pointers if you write, that should be good, people. Okay, Saru. Yeah. 1 minute. Let me take some water. So first time all this question comes in exam, how do we tackle it, sir? Sir, as I always keep saying, okay, it's the attitude that defines whether you will clear the examination or not. Okay, preparation is important, but at the same time, attitude is even more important. Okay, so don't put yourself into that negative thought always. So what if extra question comes? What if something which I have not prepared comes? Sir, you are writing one of the tough exams of the country. So few questions, alright, will be little tricky or new. You could say around 25 to 30 marks. Doesn't matter from whom you have taken the coaching, how much of RTPs, MTPs you have done. 20 to 30 marks paper will be different. The adjustments will be either lengthy, tricky or maybe both. Okay, they will give it. Otherwise, if everything they ask from the books means, obviously everyone will clear out, no, sir. right? So obviously after CA also you will suffer some challenges, right? Some clients act cranky, we have to manage, right? So even after qualifying also there will be some professional challenges which we will face. So institute also is trying to give you the glimpse of your future. So it's not only a rewarding career, there's some troubles also will come, no? So some troubles will be there in examination also. So don't worry about that 25-30 marks new concept or new question that may come, that can come. We don't know, usually it comes, right? Focus more towards the other 70 to 80 marks paper, which will be pretty straightforward. Try to score more there, okay? In about that 70 marks or something, try to score 50, 60, as much as possible. Try to answer with the precision, all right? In this 30, 40 marks, even if you get 8 to 10 marks extra, go in the, you tell some God's name, you Mother Nature or God, whatever you believe in, pray and write something, you'll click, okay? So it's all about confidence. Just because you see a new question, don't start thinking about it. All these new questions, lengthy questions, you answer it at the end. Small questions, and those questions where you are conceptually very clear, which you feel you can answer with precision, write that first. So when you keep writing that, and when you know that, okay, I've written all this properly, okay, you know that you'll get good marks, the confidence will automatically increase. So this way, some new questions, you'll be able to tackle better. So instead of getting 3 marks, you may end up getting 5 to 6 marks. Some extra point may click, right? You never know, all this happens. So just keep your head high, confidence high. Okay, all of our dumb guys, if dumb guy like me can clear CA exam, brilliant chaps like you will aram clear examination. Okay, yes, so just believe in yourself, trust yourself, things will work out. Okay, so going to the next question now. Question 15. At 31st March 20X1, the assets of CGU, cash generating units, are being reviewed for impairment. Okay, we're doing the impairment check at cash generating unit level. The carrying amount of CGU ka net asset is given to be 65 lakhs. So CGU ka net asset value is 65 lakh, excluding restructuring provision. We've studied Ind AS 37, no? Restructuring provision, like what? If you're planning to fire any employees, if there is any change in the management structure, planning to sell off any division, all that case may we call it as restructuring. For committed cost of restructuring where constructive obligation is arised, can you recognize the restructuring provision? Yes, that is as per Ind AS 37. Okay, so this particular 65 lakh which you have got it as CGU ka net asset value, it excludes one liability called restructuring provision. So should we include or exclude? That they will tell in the question. Hang on. And the remaining useful life is 8 years. Okay, so life of this particular CGU ka asset is average taken to be 8 years. Management approved budgets as on 31st March 20X1 include restructuring cost of 3.5 lakh to be incurred in next year 20X2. We are on 31st March 20X1 now. Next year we are planning to incur some restructuring cost of 3.5 lakh, and the restructuring is expected to generate cost saving of 1 lakh rupees per annum from 20X3 onwards. Okay, due to restructuring, obviously we'll get some benefit. How much benefit? 1 lakh extra benefit we'll get from 20X3 onwards. The formal budgets have been prepared for 3 years to 31st March 20X4. A zero growth rate is assumed because market conditions are extremely competitive. All these are goalies, sir. We don't know. Read the requirement. What are they asking? Without restructuring consideration, they've given you some cash flows, the future cash flows. So obviously for impairment check, we need recoverable amount. No, how do you get recoverable amount? Higher value in use and net selling price, or fair value less cost to sell. Correct? No. So excuse me. For that they've given the future cash flows, sir. Fair value in use nothing but present value of future cash flows, right? So without restructuring, this is the cash flows. With restructuring, or this is with, this is without. Okay, if you just check the value, without is 8.7. Restructuring cost is 3.5, no? Correct, they only gave over here, restructuring is 3.5. So 8.7 minus 3.5 if you do, you'll obviously get 5.2. And due to restructuring, you said you'll get an extra cost saving, meaning benefit of 1 lakh. So without restructuring, if benefit is 9 means, with restructuring it will be 9 plus 1, 10 lakh. If this is 9.5 means, this will be 1 lakh more. Like that they've given. These are all your future cash flows. Okay, that's what they've given here, that's okay. Discount rate is given to be 4%. Great, what are they asking? Okay, compute impairment loss under 2 particular scenario. Restructuring cost is recognized in financial statement, one scenario. Restructuring cost is not recognized. So under both the scenario, they're asking us to calculate impairment loss. That's all, sir. Only what's our value in use will change, no? That's all. What is there? Fatafat will calculate. It's a very simple question. Looks fancy, but very straightforward question. So with restructuring, without restructuring. So with restructuring, okay, which is this. For impairment loss, we need carrying amount and recoverable amount. Here, if you just check, the fair value less cost to sell data and all is not given. Okay, so only value in use data is given. They're still asking you to compute impairment loss. That means what will we assume? Value in use itself, will assume it as a recoverable amount because absence of data in the question. What can we do? Yes, no, not given. So we'll ignore that. Value in use itself, will take it as a recoverable amount. How do you get value in use? All this future cash flow is discounted at 4%. That's what they've done over here. These are your future cash flows. They have taken the discount factor and multiplied. So with the restructuring, if you do, value in use will be 65,15,000. That value in use itself becomes your recoverable amount. What is the carrying amount that they have given? So first case mein, without making restructuring provision, carrying amount is 65 lakh. Okay, let's look at this. This is impairment loss with restructuring we are doing. Existing carrying amount of CGU is 65 lakh. Does the 65 lakh include provision? No, they said excluding provision. But should we include this restructuring provision? Yes. In the first case, we are calculating impairment loss by considering restructuring provision also. So should we take this restructuring provision into account? Yes. But does this 65 lakh include it? No. Right? So they have given you this as a net asset. Now when liability is not recognized, what is that? Provision for restructuring. So when you recognize a liability, obviously what's that? Net asset balance will reduce. Yes, no? Because net asset is nothing but asset minus liability. No? If asset was 100, liability was 20, means net asset will be 80. If asset is still 100, liability it is not 20, it is 30, means how much will be net asset? It will become 70. So if liability increases from 20, if it becomes 30, then net asset will reduce. Okay. So now in the 65 lakh, restructuring provision liability is not included. Should we consider it for impairment loss? Yes. In the first case, they are asking us to consider restructuring provision. So reduce restructuring provision. How much is that? They only given the question restructuring provision is 3.5 lakh rupees. So make that. So that means what will be the revised carrying amount? 61,50,000. Then what is the recoverable amount? Fair value less cost to sell is not given. So value in use itself becomes recoverable amount. How much is that? 65,14,000. Carrying amount 61, recoverable amount 65. So carrying amount is not exceeding recoverable amount. Will there be any impairment loss? No. What will be the SPL impact? They have not asked, but study material has presented like this. So also I gave the SPL impact. SPL impact is what? One, you have to make provision for restructuring. So entry is P&L account, SPL account, debit to provision for restructuring. So restructuring provision will have an impact on SPL. Impairment loss also will have an impact, but in this case, impairment loss is 0. So the total impact is 3.5 lakh. This is the case where what, sir? Impairment loss you have calculated with considering or by considering restructuring provision. Next, the same data they are asking you to calculate, but without including restructuring provision. They are asking you to exclude restructuring provision and calculate. That's a requirement of the question. So what is the carrying amount of CGU? 65 lakh. This is anyway excluding restructuring provision. Yeah. So it should not be included. It is not included also. So what do you have to do? No more adjustment. So carrying amount is 65 lakh because we are not considering restructuring provision in case 2. Recoverable amount is value in use. Without value in use, if you calculate, without restructuring provision, if you calculate present value, you will get 62,73,000. That is nothing but your value in use, which itself becomes your recoverable amount. So for second case, recoverable amount is 62.73. Carrying amount 65, recoverable amount 62. So you will get impairment loss of 2,27,000. In second case, you are getting impairment loss. So what is the SPL impact? You are not making any restructuring provision, so that is 0. But do you have any impairment loss? Yes, which is 2,27,000. That will be transferred off to SPL account. So total impact is this much. Okay, that's all is a simple question all about. Given in a little fancy way, but the calculation part is very, very straightforward. Okay, put up what this as working note number 1. You calculate for recoverable amount. Okay, then what, sir? Put up this and this. This is your final solution. That's all you have to do. This, if you calculate, you'll get around 6 to 8 marks. Okay, very, very straightforward question. Correct? No. So this was about your question number 15. I hope I can go for question number 16. Yes. Question number 16. SS Limited had the following transaction during the financial year 20X1X2. On 1st April 20X1, SS Limited purchased net assets of M Limited for 13,20,000. Business combination. So PC is 13,20,000. They said purchased, right? So if they don't say anything, it is 100% purchase. So NCI portion here is 0. Okay, non-controlling interest is 0. Fair value of net asset is 10 lakh. So how do you calculate goodwill? PC, right? Then add non-controlling interest ka value, which is in this case is 0. Reduce net assets on the date of control, which is given to be 10 lakh. So 13,20,000 minus the fair value of net assets on the date of control, which is 10 lakh. So goodwill on the date of control, you will get it as 3,20,000. And we have already studied this particular goodwill, which arises as part of Ind AS 103 business combination. Do you amortize them? No. You only this goodwill is not amortized, but you only check for impairment of this on an annual basis. Every year, this particular goodwill is impaired or not, you need to compulsorily check. Okay, whether impairment indicator is there or not, that is irrelevant. Once at least every year, you need to check whether this goodwill is impaired or not. Correct, sir? Okay, now what is the requirement of this question is, I'll just show you. Okay, what they've asked in this particular question is, they're asking you to prepare one intangible assets schedule. That's all. Meaning, what is the opening balance of intangible asset, what is the closing balance, how much it got amortized, etc. etc. Okay, and what is the schedule of related expense in SPL. So balance sheet ka and P&L ka extract they have calculated. That's all, sir. So what is this goodwill now? If you calculate, this goodwill is 3,20,000 that got added in the current year. Will we amortize this goodwill? No, amortization is 0. So closing balance will be 3,20,000. So this 3,20,000, we have many assets. We'll combine. This is the schedule. This is your notes to intangible asset. We'll combine everything. We'll get the final value. We'll show it in balance sheet. That they are asking us to prepare. So they've given various intangible assets over here. Very, very straightforward question. On 4th May 20x1, S purchased a franchisee to organize musical shows from ATV for 80 lakh. Franchisee rights were purchased. So is it an intangible asset? Yes. It's a purchased one. How much did we purchase it for? 80 lakh. So can we capitalize 80 lakh? Yes. An annual fee of 2% of musical shows ka revenue. So we have purchased a franchisee rights through which we'll conduct shows, right? We have paid 80 lakh for franchisee rights. Other than that, whenever we conduct shows, musical shows, whatever revenue we generate, 2% of that also we have to pay. So all these are what, sir? Annual expenditure. So this 2% on will it be capitalized? No, this 2% will go off to annual fees will go off to SPL account. So revenue is 10 lakh. Annual revenue you got in the current year is 10 lakh. So 10 lakh at 2%, which is 20,000 will be transferred off to SPL account. Okay. Alright. Projected future revenue for, in fact, the franchisee expires after 5 years. So this 80 lakh, you have to amortize it over 5 years. 80 lakh, residual value not given, so 0. Projected cash flows they have given, that's okay, fine, fair enough. So you purchased it for 80 lakh, life is 5 years, so 80 divided by 5 is 16 lakh. So a franchisee will be amortized every year for 16 lakh. You bought it for 80, first year amortization is 16, so closing balance is 64. So you purchased in May, no sir, so we should not calculate full year amortization. Yes, they have given in the data that company has made an accounting policy to amortize all intangible assets on SLM basis, okay. By permitting Ind AS, taking full year amortization in the year of acquisition. Specifically, they have given in the question that in the year they acquire it, whether it is acquired for 8 months, 9 months, 6 months, 3 months, 1 year, doesn't matter. First year amortization will always be calculated for full year or 12 months. A specific requirement in the question. So the day you have purchased all these intangible assets in this problem becomes irrelevant. If this line was not given, obviously we would have amortized it only from 4th May onwards. Okay, meaning for 10 years some days or 10 months some days, yes, like that. So here, since they've said that first year you charge full year amortization, we have calculated that. And this 20,000 annual fees will go off to P&L account. So you'll see that in P&L statement. Okay, here if you see P&L, this one, franchisee annual fees, 20,000 has come to P&L. Okay, that's it. Then one more asset is there. These two are over. 4th July, date is anyway irrelevant because first in the year of acquisition, full amortization. SS Limited granted a copyright intangible asset by M Limited, okay. During the year 20x1x2 current year, SS Limited incurred 2,50,000 on legal cost to register the patent. So registration cost of the patent is your directly attributable cost. So can you capitalize? Yes, 2,50,000 you can capitalize. Okay, 7 lakh additional cost to successfully prosecute a copyright infringement suit against a competitor. So we filed a case against our competitor. Maybe they are using the same copyright. Okay, so we filed a case against them because we are proving that we are saying that this copyright is ours. Our competitor is unfaithfully, or he's using it and getting the benefit. So we have filed a case. To defend that case, we incurred 7 lakh rupees. Sir, all these are what, sir? Maintenance expenditure, right? All this cannot be capitalized. They will be going off to what? P&L account. So registration charges, patent ka, can you capitalize? Yes. So what price did you buy copyright? Not given, maybe 0. But 2,50,000 you can capitalize. So copyright ka value will become, purchase value they have not given, registration value they have given as 2,50,000. So the value of copyright will be taken as 2,50,000. Okay. For how many years this copyright is going to last for? Life is 10 years. So this will be amortized over 10 years. 2,50,000 divided by 10 years if you calculate, you will get 25,000. And the closing balance will be 250 minus 25 will be 225. All these are total intangible assets, 69,45,000, which will be shown in your balance sheet. Then P&L mein all these are amortization charges. Total is 16,25,000 amortization charges in P&L. Then that legal cost on copyright defending charges also goes off to P&L. So this will come under other expense, 7,20,000. This is your P&L and balance sheet ka extract that they've asked, sir. That's all. A simple calculation and putting it in the respective format is what they're asking. A very, very straightforward question, nothing much at all here. Yes, sir. Requirement is done, that's all. Nothing much. Okay. Quick review you do. All the format, I'm sure you are comfortable, right? Schedules and all, you're comfortable with presentation. Just quickly review that one so that you know what's the requirement and accordingly you put it up. Okay, question number 17. On 1st October 20X1, XY completed the construction of a power generating facility. Sir, it is a self-generated PP. Okay. 1st October it is completed. Construction cost was 2 crore. Okay. The facility was capable to be used from 1st October. So from 1st October only it is available for use, and we have studied. Depreciation starts from the day PP is available for use. Put to use is irrelevant for depreciation in accounts, right? So depreciation starts from 1st October. Facility was actually put to use on 1st January. That is irrelevant for us. We want available for use date, which is 1st October. Life was given it as 40 years. Okay. Alright. And our current year begins on 1st April. Do not forget that. Okay. So in the current year, October, November, December, January, February, March. Only for 6 months in the current year, the asset is available for use. So you will calculate depreciation in the current year only for 6 months. Under legal regulation in the jurisdiction in which XY Limited, the company operates, there is no requirement to restore the land. There is no DSR cost on which the power generating facility stand to its original state. As per the law, we don't have to restore the land. Okay. However, the company has a reputation for conducting the business in environmentally friendly way and has previously chosen to restore similar land even in the absence of legal requirement. Okay. So legal obligation is not there over here. We have studied in Ind AS 37 that obligation could be of two types: legal obligation, constructive obligation. Legal obligations are those which arise as part of contract or law. Constructive obligations are those which arise as part of your previous trade practices and customs. So in this case, though there is no legal requirement, the company ka past practice show that we do this. So here there is a constructive obligation exist. So should we make provision for DSR? Yes, because for Ind AS 37 ka provision accounting, either legal obligation or constructive obligation. If anything is there means you do the accounting. Here constructive obligation exists, so provision for DSR should be accounted. Okay, but mind you, it should be capitalized, not transferred to P&L. This is DSR. Okay, the director has estimated that the cost of restoring the land is 40 years. Life is 40 years, no? So after 40 years, you have to restore the land. So that time you will incur. So that time when you incur repair cost, it will be 1 crore. This is a future value. Will you capitalize provision for DSR? Yes. At future value? No, we have to calculate present value. For that, we need discount factor given as 5%. At 5%, they only calculated PVIF. For 40 years at 5%, PVIF is 0.142. So 1 crore multiplied by 0.142 if you do, you'll get 14,20,000. That is a present value of DSR cost to be capitalized. Explain how the treatment will be calculated for the year ended 31st March 20X1. Very simple calculation, sir. Here, carrying amount of PP. Cost of PP on 1st October, the day it is available for use. How much did you pay to construct that asset? They're given somewhere here, 2 crore rupees. Totally you spend 2 crore for construction cost. This is one. Then provision for DSR should we add? Yes. 1 crore you will incur after 40 years. Multiplied by the discount factor, we got present value 14,20,000. So the carrying amount of PP on 1st October, adding these two will become 2 crore 14,20,000. Asset is available for use on 1st October and year is ending on 31st March. So in the current year, we have used the asset only for 6 months and the life is 40 years. So how do you calculate depreciation? Carrying amount, which is this, minus residual value, not given 0, divided by life, which is 40 years, into current year ka 6 months depre, you will get depreciation. Yes. So carrying amount of PP for the year end will be this much. Then on provision for DSR, you have to do unwinding of interest while accounting. That ACM table you need to put up. They only ask current year ka data, hence only calculated for current year. So opening balance of provision for DSR is 14,20,000. What is the discount factor? 5%. So here you have to calculate, it's a liability. On liability, we calculate finance charges. At what rate? 5%. So 14,20,000 ka 5%. Don't leave it at that. It's not 14,20,000 into 5%. It is 14,20,000 into 5% for 6 months. Okay, because all this provision is coming on 1st October. Okay, and year is ending on 31st March. So the current year finance charges also will be calculated only for 6 months like depreciation only. So finance charges will be 35. There is no payment because the payment for provision for DSR you will make after 40th or at the end of 40th year. So payment is 0. So closing balance will be these two ka addition, this ka minus, which will be 14,55,500. This is your provision ka balance. That's what they've asked. A very, very straightforward, again, a simple, straightforward question. This much if you're right, it's good enough. If you have asked for little extra marks, means write some pointers also. Depreciation starts from the day PP is available for use. Provision for DSR should be capitalized when provision should be accounted when constructive obligation arises. What is the meaning of constructive obligation? Then you can write provision for DSR is recognized at present value. The difference between present value and future value is time value of money ka finance charges transferred to SPL. All that story, 3-4 points extra masalas if you want to put. Based on the marks, you can decide. If it comes only for like 2 to 3 marks, this much is good enough. So decide the presentation based on the marks in the question. Okay. Hope we can go for the next question. Yeah, question number 18. No. X Limited commenced the construction of a plant, it's a qualifying asset, on 1st September 20x1, estimated at a cost of 10 crore. Okay. For this purpose, X has not raised any specific borrowing. So that means maybe you have taken a general borrowing. On general borrowing, we need a weighted average capitalization rate. Rather, it intends to use general borrowing, which has a weighted average cost of 11%. So they only calculated that weighted average rate, which is 11%. So we don't have to worry about that weighted average rate at all. The borrowing cost incurred during the period 1st September to 31st March is 0.05 crore. This is the total borrowing cost we have paid. Simple common sense. Sir, if you have paid 0.4 crore means can you capitalize more? No. You take weighted average capitalization rate and calculate the borrowing cost. But whatever calculated number you get, it should not exceed 0.5 crore. Correct? No, because totally you have incurred only 0.5 means capitalization can be more than that. No. That's maybe last conclusion. Maybe you have to write that. Okay. Now, if you just check the table, they've given you the cost of construction accrued. This is obviously to construct an asset, you will incur various costs. So this is the not cost paid wala date amount. This is the cost accrued wala information they've given. Accrual basis of cost information they've given. And this is the cash outflows. This is the payment data and this is the cost accrued data is what they've given. Now, the question is, sir, to calculate the weighted average borrowing cost and all, we have to do time weights, right? Should we take this data and do it or this data and do it? Is the confusion over here. Okay. Sir, if you just check for capitalization of borrowing cost, as per Ind AS 23, there were 3 conditions, if you remember. One, expenditure on, first condition is borrowing cost should be incurred. The day when all the 3 conditions get satisfied, borrowing cost you can capitalize. One, borrowing cost should be incurred. Okay. Second one, expenditure on qualifying assets should be incurred. Third one, activities relating to qualifying assets should have begun. The activities includes planning administrative activities also. Now stress upon the second point. What are they saying? First is borrowing cost should be incurred, meaning you should be paying borrowing cost. Second one, expenditure on qualifying assets should be incurred. When they say incurred, they mean to say the outflow, cash flow. So that means for the condition for borrowing cost capitalization is not based on accrual basis. It is based on the payment basis. You calculate that borrowing cost based on the payment basis, not on accrual basis. So this first information what is given in the question to us is irrelevant because this particular capitalization of borrowing cost is based on the amount spent. It is based on cash outflow wala data and not on accrual basis. Accounting is done on accrual basis, okay? But this particular Ind AS 23 ka condition for capitalization runs on a cash basis and not accrual basis. Hence, this particular data what they have given in the question is absolutely irrelevant. Okay, take this and calculate. Now it's very simple, no, sir. This is the amount. Even we don't have to calculate weighted average rate also. They've given us 11%. Multiple ways to do it. One, you calculate time weights of this alone. Meaning like the way they've done in study material. If you just check the solution, I'll quickly run you through that. 1 minute. Where is that? Here. This is the month of expenditure in which you have incurred the cost. Okay. Don't worry about this. Okay, they have calculated for both. You don't worry about this accrual at all. Leave that irrelevant. Okay, take only the outflows. Okay, this they have given in the question. September, you have incurred an outflow of 3 crores or whatever the number is there. Okay, now you have to calculate time weights because it is weighted average capitalization rate. September you've incurred this, and year is ending on March. So September, October, November, December, January, February, March. So the time weight is 7 months. So 3 into 7 by 12 you'll get the amount. Like this, you calculate time weighted expenditure. This you've incurred in October. So October to March, if you count, 1st October it is. So it will be 6 months. So 1.7 into 6 by 12, you'll get the value. So take the respective amount and multiply by the respective weight. You'll get this much amount, right? And then finally 4.02 you got. This is the expenditure. To that you multiply capitalization rate, which is 11%. So if you do that, that's what they've done here. 4.02 crore. This is irrelevant. Don't write all that. Okay. We can write one liner. That borrowing cost ka capitalization is based on payment basis and not accrual basis. Write that extra data now you can cut off. So 4.02 crore into 11% if you do, you'll get 0.44 crores. That is the borrowing cost you can capitalize. This is one way of presentation. Okay. Calculate only time weighted expenditure, and after they take this time weighted expenditure and multiply by the weighted average capitalization rate. Like that you can do. That is one approach. Or instead of that, you can calculate like this. I feel this is easier. Okay. Instead of finding time weighted expenditure and all, this is the expenditure, no? Right? So take 3 crores or whatever is the amount. Actually, yeah, crores only. 3 crores. When did you incur this? September. So September, October, November, December, January, February, March. How many months? 7 months. So into 7 by 12, into directly multiply 11%. Instead of multiplying 11%, first finding out the time weighted expenditure and then multiplying 11% in the end, at respective stage itself multiply 11%, so that directly borrowing cost to be capitalized only you will get off. So make this only as a working note. Month, okay, cash outflows, and then next column you can write as borrowing cost to be capitalized. So basically this multiplied by the time weight 7 by 12 into the capitalization rate 11%. So if you multiply you will get. So multiply 11% individually to all these amounts into the respective time weights, 6 by 12, 5 by 12 or whatever. Here you have incurred this expenditure in March, 1st March. So year is ending on 31st March. So that means 1 by 12 you will multiply. So if you calculate, you will get the same number. So borrowing cost to be capitalized will be 0.44 crores. That's what it is. Okay, sir. So if you write this sentence and calculate this and maybe one more conclusion, it is sufficient. They have given big solution and ICA. That is just for understanding purpose, explanation purpose. You don't have to write so much in examination. Okay. Third conclusion, what you can write is, in this problem, specifically they told actual borrowing cost incurred is only 0.5. Okay. How much you are planning to capitalize? 0.44. So that you need to write. Borrowing cost capitalized. In this problem, how much are you planning to capitalize relating to general borrowing? 0.44. It should not exceed the actual borrowing cost incurred 0.5. Obviously, no sir. If you get this supposed to be 0.7, can you capitalize 0.7? That will be nonsense. Why? Sir, you have incurred a borrowing cost only 0.5 means, can you capitalize 0.7? No. So since they have given this, usually they don't give this particular data in the question. If they give you that data, give the last conclusion. The actual borrowing cost to be capitalized should not exceed the actual borrowing cost incurred. That one line if you write, that is good enough. So this 3 points, if you present, in my opinion, that is good enough for the examination. Okay. No need to write full stories and all like the way they presented there. Okay, G, 2 more questions and we are done. Okay. Yeah, that's all with respect to this question. Question number 19 is based on Ind AS 110 consolidated financial statement. Actually, it is Ind AS 110 and Ind AS 103 ka 1 or 2 concepts, PC concepts they brought in. So you could say this is a little combo question of Ind AS 110 and Ind AS 103. So we'll see what we can learn. A very straightforward question. Obviously, consolidation questions are little time consuming, but conceptually pretty straightforward. Nothing new from this particular question in my view. So on 1st April 20x1, A Limited acquired 80% of share capital of S. So on 1st April they got control. So that is your date of control date. Yeah, DOC as in date of control. On the acquisition date, share capital and reserves of S Limited stood at 5 and 1,25,000 respectively. This is necessary for us to calculate net assets, because you know how to calculate net assets. Now we take share capital, we take all the reserves, we do some fair value adjustments if you have any, correct? Then we will get the net assets on the date of control. So these 2 information are helpful for our net assets on the date of control wala calculation. A Limited paid initial cash consideration of 10 lakh. This is your PC. Okay. Additionally, A Limited issued 2 lakh equity shares of nominal value, as in face value 1 per share, but at a current market price of 1.8. So 2 lakh shares you have issued, each ka value is 1.8. So that means we have to take the issue price, which is market value 1.8. So 3,60,000 we have paid in the form of equity shares. PC can be given in various formats, no? Cash, equity shares, deferred consideration, contingent consideration, right? Prorated SBPR, all this we have studied, right? So yeah, here one more form of PC given here is equity shares. It also agreed that A Limited would pay a further sum of 5 lakh rupees. They'll pay a further sum of 5 lakh rupees after 3 years. So they will pay 5 lakh. So what? There is no conditions attached. So is this a contingent consideration? No. This is a deferred consideration because you're not paying this immediately. You're deferring it over, or you're paying this after 3 years. So this only we call it as deferred consideration. So can we take PC to be 5 lakh now? No. This 5 lakh you'll pay after 3 years. So this 5 lakh is a future value. For PC, we are doing the calculation now on the date of control. So we need to find out present value. For that, they would give a discount factor. Discount factor is 10%. Since the payment you're making after 3 years, the third year ka discount factor if you take 0.75. So 5 lakh into 0.75 you'll get present value of deferred consideration that will form part of PC. So these three if you add, you will get PC. Okay. That is one working note you need to put up because PC is not straight away given to you in the question here. One working note for PC in here. In fact, I put it up. If you want, you can just check here. Finish off there only. Cash is 1000. All the numbers we are presenting in thousands because next table data, no, they've all given in thousands here. That's the reason all the above also we can present in thousands. So three forms. One is 10 lakh cash, which when you present in 1000, it becomes 1000. Then equity shares, 2 lakh equity shares issued at 1.8 market price. So totally 3,60,000. When presented in 1000, it becomes 360. Then deferred consideration of 5 lakh multiply by discount factor, you will get present value of or provision for deferred consideration at present value, which will be 3,75,000. Adding all this, you will get PC to be 17,35,000. Okay, that's all. Next, what is there? Shares and deferred consideration have not been recorded by A Limited. They forgot to record. That means what? The data given in the question, no, exclude share capital. You have issued any extra shares? Yeah. 2 lakh extra shares you have issued. Share capital always shown at face value or nominal value. So 2 lakh when you have to present in thousands, it will become 200. So due to this particular transaction, share capital, no, the given share capital in the question is 2000. You should not take 2000. They forgot to record one extra shares issued. So which will be 2 lakh. 2 lakh when you present in 1000 becomes 200. So due to this equity share capital, you have to increase by 200. And these shares are issued at premium. So security premium, you have to increase by 2 lakh into 0.8. 1 rupee was the nominal value. You issued it at 1.8. So the premium per share is 0.8. So 1,60,000 is a total premium. When present in 1000, it becomes 160. So security premium. Do not forget to take security premium in your other equity. We prepare a working note for other equity here. You have to increase security premium or take security premium there to the extent of 1,60,000. And also provision for deferred consideration depends. It will maybe come under current liability or non-current liability depending on the settlement date and the year for which we are preparing consolidated balance sheet. Because they can ask it for first year, they can ask it for second year, we don't know, right? So either it will come, this provision for deferred consideration, either it will come under current liability or non-current liability. We'll read the data and decode it. The balance sheet of A Limited and S Limited as on 31st March 20x3. Look at the dates, sir. So you got the control on 1st April 20x1. So first year will be 1st April 20x1 to 31st March 20x2. They are not asking you to prepare CFS for this year. They have given the balance sheet on 31st March 20x3. So second year will be 1st April 20x2 to 31st March 20x3. We are to prepare consolidated financial statement for second year. Okay. So we got the control 2 years before. For the second year ending, they are asking you to prepare CFS. Okay. That means this provision for deferred consideration will come under current liability. Because settlement was after 3 years. We are in the second year. You will settle this by the end of third year ending. So anything which is expected to be settled within 1 year from the end of current financial year is a current liability. We have studied this. From the balance sheet date, count 12 months. If any liability, if you are settling within 12 months from the current year ka balance sheet date, then it is a current liability. So this provision for deferred consideration, when you prepare in the current year CFS, you will show it as current liability. For year 1, you would have shown it as non-current. Yes, no, because the settlement is beyond 1 year. So first year when you prepared CFS, you would have shown provision for deferred consideration as a non-current liability. Since they are asking us to prepare for second year, provision for deferred consideration will have to be shown as a current liability. Now, sir, for that provision, we need to prepare interest table, sir. Yes, unwinding of interest table will come because you have recorded at present value, no, but settlement will happen at future value. So there you will get 3 years ka interest charges you need to put up. Now, since we are in the second year, we'll have to calculate the ACM table for 2 years if you put up. That is a requirement. We'll do it a little later. Okay. Next, balance sheet they've given. Fine. Normal balance sheet. That's okay. Further information they've given on the date of acquisition, meaning on the date of control, the fair value of subsidiary company S Limited, plant, subsidiary company has one plant. Their S Limited's plant exceeded its book value. The fair value of S Limited ka plant exceeded book value by 2 lakh. So they're saying it's a revaluation adjustment. This is our fair value adjustment. So compared to book value, fair value is more by 2 lakh rupees. Normally they give fair value and we compare it with book value and then we say whether there is a fair value increase or decrease. Here that increase, decrease, they have only given. They have compared the fair value exceeded book value by 2 lakh. So compared to carrying amount, fair value is more than 2 lakh. And as per Ind AS 103, we know that all subsidiary ka net assets have to be taken on fair value. Okay, so for consolidation purpose, we have to take 2 lakh rupees more. So this is a fair value adjustments which we have to consider for net asset wala calculation. The plant had a remaining useful life of 5 years. Since we are taking value higher than carrying amount, okay, due to this adjustment, we will get additional depreciation. All this we have studied. Yes, no, sir. So there is a fair value increase in one of the assets for 2 lakh. For consolidation purpose, we are not taking carrying amount. We are taking 2 lakh more. Since we have increasing the asset value by 2 lakh more, and this 2 lakh rupees, we have to also calculate additional depreciation. This is not a mistake. Okay, all these are consolidation adjustment. Subsidiary has not done it because they don't have to consider fair value. Maybe subsidiary company has followed a cost model for their PP valuation. But Ind AS 103 says that all subsidiary net assets have to be taken out fair value. So for consolidation purpose, we have to increase the carrying amount by 2 lakh. Okay. Because you are increasing the carrying amount by 2 lakh, you will also get an additional depreciation which will be captured under post-acquisition profit side. Goodwill, the consolidated goodwill that you get, they're saying is impaired by 258. So they only calculated. The group values non-controlling interest using fair value method. There are two ways in which you can value NCI. One is fair value method, another one is PSNA, proportionate share of net asset basis. Here we are using fair value basis. We own 80%, so NCI owns 20%. The fair value of NCI for 20% is 3,80,000 on the date of acquisition, meaning on the date of control, fair value of NCI, they only given it to be 3,80,000, no need to compute. We need to prepare consolidated balance sheet. Notes is balance sheet and all is not required, they're asking. Okay, simple working notes, sir. Okay, first step, PC ka data was missing, so we put up one working note for PC. Then, normally in these problem, I have solved this question exactly like the way we solve our consolidation question. Remember we made a format. In that format only I've solved, and these formats are not compulsory, people. You can change them. Okay, especially some of the audience who are watching this on YouTube by any chance. If you have any other method, you can present them. In our class, when we did regular class, or for that matter fast track classes, we followed this format so that this format gets stuck in our mind and we can replicate that for all our questions. So I've tried to solve this question also under the same format. Okay. So first working note we put up for fair value adjustments. Okay. Normally we compare carrying amount with fair value and get the fair value increase or decrease. Here no need to put up that because they've only given. What is the fair value increase or fair value adjustment is given to be 2 lakh rupees. All amounts are in 1000, so this will become 200. Now since the fair value is greater than carrying amount by 2 lakh, you have to increase the asset value, you will get additional depreciation due to this. If it was fair value decrease, means you will get reversal of depreciation. Here you are increasing the value of the asset, so you have to charge extra depreciation for consolidation purpose. So 200 is the value of asset you have increased. Residual value information not given, so 0. Life remaining, they've only given in the question to be 5 years, so divided by 5 years. Okay, all right. Do not forget to multiply it by 2 years. Why, sir? Sir, we are preparing consolidated financial statement for second year. Okay, for this year we are preparing CFS, and this fair value adjustments and all you will do it on the date of control. Okay, so that means you have to calculate the impact from the date of control to current year ka consolidated balance sheet date or consolidated financial statement date. Date of control is 1st April 20x1, but we are preparing consolidated financial statement as on 31st March 20x3. So if you count from here to here, it is 2 years. Okay, year 1 ka depreciation, year 2 ka depreciation. So for both 2 years ka if you calculate, the total additional depreciation for 2 years is 80. So do not forget this. This is one adjustment. You may forget. We have done such question in our regular class. Okay, not a new thing, but just calling it out. If someone has not attended our regular class and watching it for the first time, that is one. Okay, because all this fair value adjustments you have to do it on the date of control. Now, from the date of control, you need to count till the consolidation financial statement date. That period is 2 years, hence multiply by 2 years. Okay, so the net impact is, so due to this adjustment, PP balance will increase by 2. And when you charge additional depreciation, PP balance will reduce. So the net impact is by 1,20,000 PP balance you need to increase. That I will tell you in consolidated balance sheet. This is one. Okay. Then PC ka working note we have already done. That is okay, simple. Next, what do we calculate, sir? we have to calculate net assets on the date of control. How do you get that? Take all the share capital, add all the reserves and surplus existing on the date of control date, or other equities existing on the date of control date. Yeah, and then if there is any fair value adjustments required as per Ind AS 103, consider that. They have given that information. Check the share capital and reserves and surplus on the date of control is 5 lakh and 125 respectively. 5 and 125 given in the question. Okay, and the fair value adjustments on the date of control, just now we got it to be 200. Okay, this is the fair value adjustment, meaning you have to increase the value of asset. If you increase the value of asset, means obviously net asset balance will increase. No, correct? Net asset is nothing but assets minus liability. One way to calculate net asset is asset minus liability approach. Another approach is shareholders funds approach, or equity and other equity. Equity and other equity, if you add, you will get net assets. Okay. So fair value adjustments, you got to know, due to fair value adjustment, asset balance will increase. So net asset also will increase. So adding all this, you will get net assets on the date of control to be 825. Then sir, once you have net assets, you can easily calculate goodwill. So goodwill, how do you calculate goodwill? First you take PC, then add NCI, reduce net assets on the date of control. PC we calculated here 1735. NCI they only given in the question ka adjustment is 380. Less fair value of net assets on the date of control, above we calculated 825. You will get goodwill of 1290. Okay, this is the goodwill on the date of control. Okay, control we got 2 years before. Now, is this goodwill, can you amortize this goodwill? No, this goodwill is only tested for impairment. Is there any impairment on such goodwill? Yes, given in the question. This goodwill is impaired by 2,58,000. Numbers are in thousands, so reduce 258 impairment loss. So, on the date of preparing consolidated financial statement, that is 31st March 20x3, okay, the value of goodwill is how much? After reducing impairment loss, the value of goodwill is 1032. This will come in your consolidated balance sheet. This is your working note number 4. Okay, G. Yeah, working note number 5 is post-acquisition, analysis of post-acquisition reserves and surplus of the subsidiary company, which is S Limited. Now, on the day you acquired subsidiary company, their reserves and surplus was 125. On the date of control, it was 125. Now, they have given the balance sheet on 31st March 20x3. Yes. In this balance sheet, you are able to see this is A Limited ka and this is S Limited ka data they have given. Yes. What is S Limited ka retained earnings? So, the day you acquired it was 125. Now, it has become 300. On the date of control, it was 125. After 2 years, it has become 300. That means it has increased by 175. So what is that? This increase has come after holding company or parent company has acquired the shares. So this 175 is your post-acquisition profits. Yes, no? Correct. Then, is there any adjustment? Is there any sales made by subsidiary company to holding company, upstream sales and all? No. All that adjustment is not there. But is there any fair value adjustment? Yes. Due to fair value adjustments, will you get any additional depreciation? Yes. Now, fair value adjustment was done 2 years before. What is additional depreciation? 80. Okay. Now we have to charge this. Subsidiary company has not accounted this because this is consolidation adjustment. So when you account this adjustment, your post-acquisition profit will reduce by how much? 80. Like this. Okay, now 175 will reduce by 80 and post-acquisition profit will become 95. Regular adjustment, all these are, yes. But you have to consider not just for 1 year because we want total post-acquisition. We are doing analysis of total post-acquisition reserve. Here the total post-acquisition reserve is not for 1 year, it is for 2 years. Hence 2 years ka additional depreciation will be considered for this particular purpose. Okay, and this is post-acquisition profit of subsidiary company. What do we do for this? Distribute among parent and NCI in the respective shareholding percentage, which is 80 and 20%. 95 into 80% if you do, you will get 76. 95 ka 20% if you do, you will get 19. That is NCI ka share. Okay, sir. That's all. No other adjustment is there over here in this particular case. Next, working note number 6, we prepared it for non-controlling interest. First, do you already know NCI on the date of control? Yeah, that they have only given us 380 in the question. Then, does NCI have any share in post-acquisition profit? Yes, NCI share is 19. So add that. Then any adjustment is there? Yes. Sir, did you get any impairment loss on goodwill? Yeah. You got impairment loss of 258. Alright. That we need to reduce. Why, sir? Sir, this impairment loss is a consolidation adjustment. Okay. Right? Subsidiary has not accounted this. So this profit of 175, you got it from subsidiary ka books. And subsidiary has not accounted this impairment loss on goodwill and all. Because this is a consolidation adjustment. So this 175 does not include impairment loss ka adjustment. Hence, okay, the profit is of subsidiary company is not 175. Impairment loss is a loss, no? So after you adjust the loss, profit will be not by 175, it will be lesser, right? Since this is not accounted by subsidiary, we show impairment loss adjustment separately. If you want, you can reduce impairment loss on goodwill here and then distribute also. Impact will be same, okay? right? That way also you can present, that is anyway your choice. Since subsidiary has not accounted this, I will show, normally we used to do in our regular class, impairment loss on goodwill as a separate adjustment, okay? But here also there is a catch. What catch? First check, sir, how was NCA valued? Because we know this, that if NCA is valued under PSNA basis, I explained you with logic and all, now I'll not go too much further. If NCA is valued under PSNA basis, then the goodwill that you get in the adjustment is only partial goodwill or only parent share of goodwill. If NCA was valued under PSNA, proportionate share of net asset basis, then the goodwill that you get on the date of control is only a partial goodwill or parent share of goodwill, and impairment loss will only be shared by the parent. That is PSNA basis. Here, do we follow PSNA basis or NCA is valued under fair value basis? Fair value basis. If NCA is valued under fair value basis, the goodwill that you get on the date of control represents your full goodwill, and any impairment loss of this will be shared both by the parent and NCA. So NCA also will have a share in this impairment loss. So 258 is the impairment loss and NCA ka share of impairment loss is 20%. So reduce that. You'll get NCA at the end of the year, DOR as in date of reporting. On 31st March 2023, that is, NCA will be 347.4. That's all. Okay, sir. Okay, next working note, usually we prepare for other equity, but hang on, here we have provision for deferred consideration, right? So, provision for deferred consideration, initially we have recorded at present value. That was 2 years before. Now we are in the end of second year, right? That means 2 years ka finance charges will come. And they said that shares issued, provision for deferred consideration and all did a parent company record this or not recorded? Not recorded. That means 2 years ka finance charges they have not recorded. And due to this finance charges, retained earnings balance will reduce. Hence, instead of preparing other equity as next working note, first prepare provision for deferred consideration. ACM table you put. Since we are in the second year now, I'll put up this table for 2 years. And then we will calculate other equity. So what is the provision for deferred consideration you accounted initially on the date of control? 375. So opening balance of provision for deferred consideration is 375. So it's a liability. So we have to calculate finance charges. What is the discount rate? They only gave the discount rate relevant for discount factor relevant for deferred consideration is 10%. So book the finance charges at 10% itself. And this finance charges goes off to SPL. And there is no payment because payment will be made only at the end of third year. First year no payment, second year also no payment. So how do you get closing balance? These two addition minus this. We'll get 412.5 as a closing balance of provision for DSR. So if you have prepared consolidated financial statement for first year, you will show provision for deferred consideration 412 and you will show this as non-current liability. Yes, because settlement will happen in the third year. That's the reason. Now we are not doing first year ka CFS, we are doing second year. First year ka closing will become second year ka opening. Now calculate on this amount 10%. 412.5 into 10% will give you 41.25. Again, payment is not made in second year, it will be made in third year. So closing balance will be these two addition minus this, which will be 453.75. This payment will be made in third year. Since you are settling this payment within 12 months from the end of current year, you have to show this as what? Current liability in your financial statement. So provision for DSR, which they have not accounted, which we have to account by considering this provision for deferred consideration, not DSR, sorry, provision for deferred consideration, we have to consider in this year ka balance sheet under current liability side of this particular value. We'll cross check that a little later. Okay. 1 minute. Yeah. Alright, so this is about this. Why did I prepare this? This is the finance charges, no, sir. This will go off to SPL and SPL only you will show it as retained earnings, right? So these two, they have not accounted. This means finance charges also indirectly is not accounted, right? So due to finance charges, retained earnings balance will reduce. So to get this, hence we prepared particular working note. Basically to get these two and this one. So because this will come in balance sheet, these two will be transferred to P&L or retained earnings balance will reduce because of these two. Hence, we put up this working note. Okay. Next is your other equity working note. Whatever reserves and surplus you have, put up everything. We have retained earnings here and we saw that shares was issued by parent company at a premium. So security premium will come and then the total. Okay. Now they have not given opening balance. Now coming back to balance sheet of A Limited. Now we know this. Whenever we prepare balance sheet, subsidiary company ka share capital and other equity will not come. Only assets and liability of subsidiary company will be added 100%. Then goodwill will be shown or bargain purchase gain, whatever you get will be shown and non-controlling interest will be shown. These are some consolidated balance sheet ka rules which we have done. Yes, no. So the share capital of subsidiary company, retained earnings of subsidiary company will not arise. Okay, maybe if you want once again I'll tell, these two will not arise. Then all other assets and liability you add 100% addition. This is 800 is total only. All this you add 100% addition. Okay. Alright. What about investment in subsidiary company? Investment in subsidiary company will not arise. Instead of investment, either goodwill or bargain purchase gain, which we used to call it as capital reserve, that will arise. Yes, no? Okay. Now, what is A Limited ka share capital? Will this come? Yes. A Limited ka share capital will come, and parent company ka retained earnings, whatever is there, it will come. So what is A Limited ka retained earnings? 1,400. Okay, this is the end of the year. We don't know whether this 1,400 is current year ka profit or it's accumulated profit. Normally, we assume this to be current year ka profit. You can assume anything. Okay, opening balance I've taken it as 0. TCI, total comprehensive income, is 1,400. That is what is the data available here. Yeah? A Limited ka 1,400. I've assumed it as total comprehensive income. You can also make it as opening balance 1,400, TCI to be 0. That is your choice because of absence of information. Then, if there is any post-acquisition profit share of subsidiary company, add. How much is post-acquisition share? We already got. Holding company ka share is 76. So add that. We have added. Then, was goodwill impaired? Yes. So NCI share of impairment loss, we already accounted. Now parent share of impairment loss. What is the impairment loss? 258. Parent share is 80%. So 258 ka 80% if you reduce, that will be reduced from retained earnings. This is one. Yes. Then provision for deferred consideration was not accounted. Hence, finance charges also indirectly is not accounted. So these two, we need to, both will go off, both are expense. Because of this, retained earnings balance will reduce. So add these two, 37.5 plus 41.25 if you add, it will be 78.75 expense. So retained earnings balance will reduce. No other adjustment. So this is your retained earnings ka closing balance, which will come as other equity. Yes. Then, since shares was issued at premium, 2 lakh shares, face value was 1, you issued it at 1.8. So the premium element is 0.8 per share. So 1,60,000 is a premium. When you present in 1,000, it becomes 160. This is your security premium element. So it's 160 security premium. So adding these two, you will show 1350.85 as other equity in your balance sheet. That's all, sir. Remaining is simple balance sheet. Balance sheet is very, very straightforward. Okay, we can quickly finish, or maybe we can review it also. So property, or why to waste? Here only we do. Okay. Property, plant and equipment, what you will do, sir? Take parent ka, subsidiary ka, you add, okay? Line by assets and liability, line by line addition. Is there any fair value adjustment? Yes, there is a fair value increase of 20, but there is an additional depreciation also 80. I think I've already done that. Maybe we can review in the interest of time. Yeah, here it is there. I'll bring it a little closer maybe. Yeah, see, 5,500 plus 1,500. Parent ka and subsidiary ka, fair value adjustment and additional depreciation. This is there in working note number 1. So that becomes your PPE ka value. Then intangible assets, goodwill, that is there in our working note. As per our working note, goodwill on the date of reporting is 1032. That is what they have taken here. Okay, sir. Then inventory and all is straightforward addition. 550 plus 100. Okay, which will be how much? 650. Then what else is there? Receivables, cash, line by line addition. 400 plus 200, 600. This is 250. 600 and 250 taken a check. Yeah, done. Asset side matched out. Liability side, share capital. What is share capital of subsidiary company will come? No, only parent ka will come. But when extra shares was issued as PC, they did not account. Worth how much? 200. So 2000 plus 200 you add. It will be 2200. 1 minute. Here. 2000 plus 200, which is 2200 as a share capital. Then other equity, they have shown retained earnings security premium separately. Since you have anyway done working note, you can show one balance. It's okay. If you check our working note, what is our working note number 8? Here. Retained earnings 1190.85. This is 160. 1190.85 and 160 security premium. You can add up these two and show directly other equity as the added number only. No need to give breakup. Then what else will come? Non-current liability, these two additions, so 3,400 directly. Okay, non-controlling interest, do not forget. Okay, that came as per our working note. Where is our working note number 6? NCA is 347.4. They have also shown as 347.4. Then current liability 1250 plus 650 plus provision for deferred consideration we need to consider. Okay, so that is what they have done over here. These two ka value in balance sheet value plus provision for deferred consideration, we got it from working note. If you just check working note number 7, we wrote it also. Provision for deferred consideration value is 453.75. So add up that, you will get the balance sheet matching value. That's all is this question all about. Okay, so just that normal consolidation question only. All these are simple, straightforward. Just that PC, no. Normally in consolidation questions, the problem we have solved, PC was directly given to you. But usually in business combination questions, they used to give breakup of PCs. That part of business combination, PC ka part, they have combined it with consolidation question and made a new question. That's all. Okay. Overall, wise, you would have studied both India's 110 and India's 103. So that way, There's nothing in this particular question is new for us. Everything is pretty straightforward only. Okay, I think we have one last question where it went for. Not able to see. 1 second. Hang on. This is 19th. Okay, yeah, this is your question number 20. Okay, a straightforward theory question. Okay, this is based on Ind AS 111 joint arrangement. PQ Limited enter into a contractual arrangement to buy a building that has 12 floors. Okay, they've come together to purchase a building, and the total building has about 12 floors, which they will lease it to other parties. Okay, P and Q Limited are authorized to lease 5 floors each. P and Q can unilaterally, meaning on their own, make all the decisions related to their respective floors and are entitled to all of income from these floors. So totally there are 12 floors in the building. Okay, in that 5 floors, P will control. He will lease it out to whoever he wants, whatever in fact he wants to do with it, P will decide based on that. He doesn't have to consult with Q. Similarly, Q, other 5 floors is there, right? Totally there are 12. 5 floors P will control, 5 floors similarly Q also will control, and this floors relating to Q, all this decision is taken unilaterally. Bilaterally means both of them have to consult and then take. Unilaterally means they can single-handedly decide for themselves. They don't have to consult the other party. So all the decision relating to this 5 floors, Q can decide how much to lease it out, whom to lease it out, for what period, whether to lease it out or not, or keep it vacant, whatever they want to do, Q can decide. Similarly, for this floors, all the decision, P can take it individually. Okay, since they want to lease it out, okay, and they have control over this assets, P Limited, what they have to do? This is not a joint arrangement, right? They have a control over this. Since they're planning to lease it out, it becomes your investment property. So P Limited has to show this 5 property in their books as investment property. Similarly, Q has control over this 5 floors. He has total control over this. So this will be recorded as investment property by Q Limited in their books. Yes, this is 5 and this is 5. Totally 10 is over. But building has totally 12 floors. That means there are 2 floors still remaining. What about that? The remaining 2 floors will be jointly managed. All decisions concerning 2 floors must be unanimously agreed upon between P and Q. So first 5 P will manage. First 5 or whatever, 5 P will totally manage. Another 5 Q will totally manage. The last 2 is there, or whichever 2 floors is there, that P and Q jointly has to come together and decide. Okay, if any decision needs to be taken out, P and Q both have to decide. That is the arrangement. Okay. Now, all the decisions concerning these 2 floors must be unanimously agreed to between P and Q, who will share net profit or net losses in respect of 2 floors equally. Whatever net profit you make, you share it equally. They both have rights to the net assets in the arrangement. So we saw in case of joint arrangements, right? In case of joint arrangements, in fact, are of 2 types: JO, joint operations, or JV, joint venture, right? The question is whether this is a JO or a JV. So in case of a JV, normally we float a new entity, right? And the parties in the joint venture have a share in the net assets of the entity. Here actually no new entity is formed, right? Okay, but the parties in the contract have a share in net assets, right? That's the reason this is what, sir. This is a joint venture arrangement. In case of joint operation, each party will have a share in their assets. That's all it is. Okay, they will not have share in the net assets and all. Okay, the moment they say the parties in the contract have a share in net assets, it is a feature of joint venture. So this particular 2 floors which is jointly managed, that they have a share in net assets. So that means this will be a joint venture type of joint arrangement. Okay, and joint venture, we know what to do. We have to follow equity method, right? So yeah, those all that accounting they have not asked. They only asked whether this is a JO or a JV. So this, since the share in net asset is given, so this becomes your joint venture wala question. Okay, sir. So with this, all the question relating to RTP November 2024 we have completed. Okay, so wish you all the very best for your upcoming examination. Okay, take care. Hope everything goes out well for you. Take care, people. Bye bye.